Good morning, everyone. This is TimeHawk from Xtrades. A little bit of a delayed start here. I know it's 6 minutes past the hour now. I am just getting everything ready and set up, but we will get going in a couple minutes. Not too much longer. Just give me a few minutes and I'll be ready to go. Thanks. All right, I am ready to go. So let's get started. Let's see. First, I'm going to switch over to display over. Let me know if you guys can see it fully, and if there's any issues, just let us know in the chat or ping somebody in our Discord. Hopefully one of the moderators, because I am unable to be on Discord at the same time. Let's see. So display. All right, got that up. Thank you guys for all the new followers. I'm doing this seminar off of, I say this every single time, but you know, I'm using a really lightweight notebook here. I am going to be building a PC soon, so hopefully, you know, I won't have any issues with streaming and stuff. But right now, I have everything on my computer basically closed, just because I want this to be as smooth as possible. Yes, and I know somebody was asking about recording. Yes, this will be recorded on YouTube as well. So, anyways, let's get started here. My name is TimeHawk. I am with Xtrades, and welcome to our 6th option seminar, the 6th in the series. And this one is going to be on butterfly spreads. So I hope you guys have all been, you know, having a good week. It's been an amazing week on the markets. You know, it's been running really high. We had a lot of really big movers, a lot of major breakouts on certain tickers, like, for example, Tesla, Netflix. I mean, you know, Baba, Baidu, whatever. There are so many growth tickers that were blowing up this week that it was hard not to make money if you were on the right side to trade. If you happen to be on the wrong side, then you might have lost big too. But hopefully you guys all made money. So enough about that. Let's go to the next slide, which is more introduction stuff. And my slide's not moving forward. Okay, there we go. So, introduction again. TimeHawk, right? That's me. I am a analyst with Xtrades, and if you guys aren't from Xtrades and are just here with us for the first time today, we are a trading community. We have a Discord with over 150,000 members. It might be over 160,000. It's been a while since I last checked, but last time I checked, it was over 150,000, and that was a month or two ago. The Bulbasaur on the top right, I noticed it's kind of cut off due to the scene, but that Bulbasaur is my profile icon on Discord, so that's how you'll recognize me. I've been trading for 7 years, and I mostly focus on swing trading. And the purpose of this course, right? So, in this course, we cover everything from basics to advanced option strategies. If you're not as familiar with more of the basics of options, how options work, what the Greeks are, I highly encourage you to go back and watch those earlier sessions, and they are available via links on our Discord. So those are posted in a few places. If you are on Discord already, you can find that in our education post channel. And I've also pinned those videos to our options swing channel. You can also find it in announcements as well, but those are the places where you can find those links for those older videos. But basically, my goal is to empower you in your trading by giving you more tools that you can use so that you can have an edge in trading, so you can trade in any kind of trading environment, okay? So right now we are in full bull mode, like especially this past week. So it's been pretty easy trading. You can probably make a lot of money just going long calls or something like that. And that works well too. There's nothing wrong with that. But sometimes, you might be in a certain market situation, like the market's really choppy and you want to have other options to play instead of just being directional, or maybe you want to hedge a little bit, something like that. And that is the purpose of this seminar series, is to go over other options, right, that you can do, other strategies that you can do to be profitable in all situations. Okay, so I always like to go over real life examples, so you'll be seeing some of that before we get into the nitty gritty of which is the main topic of this seminar. Also, in regards to questions and stuff that you guys might have, feel free to pop them over in the chat. I'll do my best to keep up with the chat, but I think mostly I'm going to be answering questions towards the end of the seminar so that when people are watching this video, they don't have to listen to 10 questions in a row about a certain topic, and instead they can listen to it at the end. Because I know a lot of people are going to be watching this later as a recording, and so we'll just try to keep it as streamlined as possible for those folks. So, try to keep your questions towards the end, or when I ask, if anybody has any questions. But feel free to drop them into the chat at any time. And then, do we have any moderators with us today? I see Young Bull. Oh, hi, 007 too. I'm sure there's probably a few other people. But yeah, if you guys I don't know if you guys are able to stay the full time or not. Usually my seminars go 1 to 2 hours. I try to keep, every single time I try to say I'm gonna keep it shorter, but it always ends up being really, really long. And the more I talk, the more I realize there's more, right? But yeah, if the moderators can help me keep track of questions, and just at the end or when I ask, if anybody has any questions, if there's any questions I haven't answered, if you could just repeat that and drop that into the chat, and then I'll get to that. So thanks for that help. All right. Before I move on to the next slide, I'm going to do my usual, disclaimer, right? The purpose of this course is for educational purposes, right? Past results are not guarantees of future results. Anything that I may in this is merely just my own opinion. and is to be used for educational purposes. May or may not be profitable, right? But basically anything I say is not a buy or sell recommendation, just my own opinion. That's it for the disclaimer. Let's move on. Hi, Photo Warrior, and good morning to you all. So I'm really excited about this topic today, butterflies, right? So the table of contents, right? So we're gonna have an options definition, quick run through. I'm not actually gonna go through all those details, but I just want to include those slides in here. Just watching the video so they can pause it if they don't know some terms, they don't know what the Greeks are, things like that. So there's gonna be a bunch of slides on that. I'm just gonna whiz through them. And then during the actual process of going through butterflies, I may explain, certain points, go back to some of the definitions, if I feel like, the audience may not understand certain topics, because I'm sure there's folks here who have a variety of backgrounds, might have more advanced knowledge of options, and some of you might just have started out this past week, for example. But yeah, then we'll be going over what is a butterfly spread, and then after that, we're going to be going over butterfly variance. So I won't be focusing too much on the variance because there's a lot. Mostly for this seminar, we are going to focus on debit butterflies, okay? So there's also credit butterflies, but we're going to be focusing on the debit ones. And there's actually a few debit ones, but we'll get to that when we get there. And then I'm going to talk about how to manage the trade, and mostly this is going to be through real-life examples that I have or have traded in the past few months or this past week. And then I'll just show you what I did, how I did it, why I did it, right? And at the very end, we're going to have a Q&A. And again, I ask that you guys talk more about your questions towards the end so that we can streamline this process. Black Panther, will we be talking about reverse iron butterflies? So, no, I will not be talking about iron butterflies. Oh, I noticed what you did there. It's reverse iron butterfly. No, I still won't be talking about those just because of time limitations. I'll be mostly focusing on 3 different types of butterflies, but you'll see what they are when we get there. Good question. Hey, Roystad. Nice to see options swing gang here. So what are options? This slide I will explain. So I view options as basically insurance, right? Textbook definition is your financial derivative for underlying security that offers the owner of the contract, so that's the option, right? The right to buy or sell at a pre-specified price, and that is the strike. So if you have a call strike at, I don't know, say Netflix, 520 calls for 716, that gives you the right to exercise at any time to buy 100 shares of Netflix at $520 per share at any time by expiration, which is, I think in that example, I said 716, right? So a few weeks from now. On the other hand, if you have puts, for example, 500p on Netflix, 500 puts, 500 strike puts, that gives you the right to sell 100 shares per contract, right? And so this right to buy 100 shares or sell 100 shares basically means that you have a leveraged position. You're paying a premium to own a pseudo 100 shares, or you're selling. So, or let's not get into to selling. Let's just stick with buying for now. But for puts, for example, you're paying a premium, or as an insurance. If you own 100 shares of the stock and you want to protect yourself from a fall in the market, and you're like, Netflix right now is at 530. I don't remember what it closed yesterday, but 520 to 530, somewhere around there. Say that you think Netflix is going to drop, or the market is going to crash next week, and you want to protect yourself, and you're like, well, the minimum price I'm willing to accept for my Netflix shares is $500. So you buy a $500 put for $3. You're paying a $3 or $300 insurance, right? Because it's multiplied by 100, right? So if your contract costs $3, that's $300. You're going to pay $300 to guarantee that I can sell Netflix at $500, which was the strike of that put. That is what the purpose of options are. They're really insurance. But of course, as leverage traders, you can leverage around with these things. And if you're playing a spread, now you don't have to own that 100 shares because you have the right to buy 100 shares. Now you have and then you're selling someone else the right to buy the 100 shares. But basically, now you're trading the difference between those two strikes, right? That's what a spread is. You're trading that difference between those two strikes. Because even though you don't own 100 shares, you have the right to buy 100 shares. And then you're selling someone else the right to buy 100 shares at a different price. And so on and so forth. The same thing applies for puts, but it's to the downside. So that is what we do as options traders. We're leveraging that ability without having to own shares. And that ties into Greeks as well. I'll touch in on that in a bit. But why options, right? Because they're versatile, volatile, and quote-unquote valuable, right? Because you are getting extra value. Instead of having to own 100 shares for a certain type of move, you can just use a options contract where you're paying a premium to own 100 shares at a certain price. That is what you're doing. Maybe, hopefully that made sense. But if it didn't, I'm sure there's a lot of better videos out there that explains this kind of topic. Okay. All right. Just checking with chat here to see if there's any questions, but all right. Looks good. Next slide. These are just options definitions. I'm not going to talk about these. Hopefully you're familiar with them. If you're not, just join our Discord, and we have a glossary page for these kinds of definitions, right? Intrinsic and extrinsic value. Intrinsic value is intrinsic value is when the call strike is in the money. So the difference between the current asset price and the option strike, that is your intrinsic value, because your contract actually has value. If I exercise right now my call, for example, 520C on Netflix, and Netflix is at $530, I can exercise my call, my right to buy 100 shares at $520, and I can sell it at $530. There's already value in it. I can gain $10 per share just by doing that. So that's why those contracts have intrinsic value. Okay, extrinsic value is when any value on top of that intrinsic value, and also if the contract is out of the money, then it's pretty much all extrinsic value, right? That's just the premium. All right. Not explaining these slides as well. Greeks. Okay. Also, not really gonna try to go too much nitty gritty here, but we're just gonna talk about delta for a second. So delta, I know a lot of people know that it measures the change in option price when the stock price moves, right? The higher the delta is, the faster your options price is going to gain or lose value as the underlying moves. So delta also represents how many, what equivalent of shares you own. So really it's the same way, it's saying the same thing, it does the same thing, but it's just a different way of thinking about it, right? So if your delta is, for example, 50 or 0.50, depending on your broker and how they display the delta, but it's 50, 0.50, same thing. If that's what your delta is, that means that instead of owning quote-unquote 100 shares, because an options contract gives you the right to buy 100 shares, right? You're getting 50% of that value. In other words, you get 50 shares. So it's like owning 50 shares when you own that contract, okay? And this is more important when you do more advanced option strategies and you're trying to keep delta neutral, etc., and you don't want to play the actual move and you're just trying to collect data, right? So just want to mention that. But data here, that's the decay in option price every day as the expiration gets nearer. Or if you're an option seller, it's how much you're gaining every single day because the value of that option is dropping. So data is really important, and a big reason of why we do spreads and advanced complex strategies is because we want to take advantage of data. We want time to be on our side instead of against us. And so that's why we do these advanced option strategies. Why data matters. So this is just a chart, as you get closer to expiration, it's exponentially decaying for that option value. And this is why we usually like to play. About 30 to 45 days is when a lot of people recommend to play options because you get that value of premium burn. And that's when talking about selling options, okay? And the same thing applies when going long options. The reason why you get longer calls is because you don't have as much decay, right? So yeah, it's just a balance between move and decay where you think that risk reward is. This is just another chart showing the difference between in the money, out of the money, and at the money options and how theta decay works on them. You can look at that on your own time. And I know I might be talking a little bit fast for some people, but that's just usually, I'm just trying to go through as much material as I can, right? And right now I'm reading the chat here. Since Netflix is $500 per share, this is from World On. I was about to say World On. But anyway, since Netflix is $500 per share if you get assigned, so assignment of 100 shares on one of the legs using butterflies, that would be $50,000. Yes, that's correct. Is it possible to increase the strike price and modify the butterfly to avoid assigned? You're on Robinhood and you have less than 25k. Okay. So we're gonna hold on to that thought, okay? We're gonna talk a little bit about how to manage butterflies later on, and hopefully that answers your question. And if not, you can ask again at that time, or if I remember, I'll try to expand a little bit more on those concepts. Thanks for the question, though. All right. So real life examples. If you guys are from our Discord, you probably know that I have been doing a Robinhood challenge account. Original start was $2,000 or $2,040, and my initial goal was $100,000 by end of the year with a stretch goal of 1 million. Right. So I started that in April 1st. If you've been, looking at winning trades or watch list or anywhere, you've probably been seeing me spamming about butterflies like for the past few months. So it was about time that I did this seminar. But that account has grown from $2,000 on April 1st to $71,900 as of yesterday market close. So that's about 3 months, right? About 3 months of trading butterflies. I only did butterflies on that account. So there's a ton of examples of butterflies on that Discord, on our Discord at Xtrades. If you're not part of Xtrades already, please do join. But yeah, like it's been a really, really amazing journey for me so far. And I think I can hit 100k probably in the next 2 weeks if the market cooperates, right? So on to the next goal. But real life example that I posted yesterday in winning trades. So this was a 9-day hold on Shop. As you can see, I opened it on June 16th. So that was sometime last week, middle of last week, I think. I think that was when... It might have been Monday. When was June 16th? That was... June 16th was Wednesday. Okay. So I was looking... I remember a lot of people were posting about Shop setups over the weekend, last weekend, and it looked really, really good, and it was breaking out. I think this is not the first time I played Shop. I played Shop a few times before this, too, but this was the trade I just closed yesterday. But I entered it, a really, really wide butterfly from 1400 to 1500. That was a debit part of the spread, and the credit part of the spread was 1500 to 1550. This might not make that much sense right now, but I'll get into that later. So this is not a normal butterfly. This is a unbalanced or a broken wing butterfly, right? A debit broken wing butterfly. But basically I gained 370%, right? And the reason why this was successful is because Shop went on a crazy, massive run, and I just happened to have good strikes for it. So, it's after you get it set up. This is true about trading for anybody. No matter how much you know, no matter how much you've traded, we try to predict the market, but it's hard to predict the market. Anything can happen. You just do the best you can to try to find the best setups, and then you position yourself appropriately with the best trading strategy for your trading style, and then you just, follow your rules, follow your risk management, follow your position sizing. If you do that, sometimes you'll lose, right? Sometimes you'll win. But overall, if you follow your rules, you should be up overall. And that's really my recommendation for anyone. Like, just because something works for me doesn't mean it will work for you. My goal is to just introduce you guys to as many different types of strategy as possible and present the pros and cons, and you guys find your own trading style based on what you learn, what you experience. No better teacher than experience on the markets. How do you monitor and adjust butterflies? We'll go over that in a future slide. Thanks for the question, though. Yeah. Trading Genius, you're asking about alerts and stuff and how I turn my account. I do, I do post alerts and stuff, but I'm actually going to talk about that later as well on how to find plays and yeah. So stay tuned for that. That'll be towards the second half of this seminar. All right, next slide. What is a butterfly spread? So what you guys may or may not already know, a butterfly is a neutral, and I put a little asterisk there, multi-leg strategy that can be viewed as a debit spread and a credit spread combined. Okay, so that's how I view it. I view a butterfly as a debit spread and a credit spread combined. So all you're doing is you're buying a debit spread, right? And that's where you buy, we use a calls, for example. You say you buy Netflix $5.20 and I sell the strike $5.50. So that's a debit spread, right? A credit spread is on the other side. So using Netflix example again, say that I sold a $550 call, $5.50. Twisting in my words here. But and then I'm gonna buy $5.80, and that's just to cover my risk of selling that $5.50, right? So that's called a credit spread because I'm receiving net income or a credit for that trade. So now I have a debit spread and a credit spread. Because a butterfly, a regular butterfly has the same width of the wings. The debit spread and the credit spread should be the same width, right? So $5.20 to $5.50, $5.50 to $5.80, both of them are $30. And I actually talk about this later, so I don't know why I'm talking about it here. But, that is a credit spread and a debit spread combined with the same width. So you have no risk on your credit spread or your debit spread other than what you put in play because they are both the same width. They that's just how the play is set up. So it's a defined risk. Your maximum loss is a debit paid. And it's also a defined reward because your maximum profit is going to be achieved at the short strike. So in this case, with that Netflix example, it's $5.50. So the most you can gain out of this play is going to be a difference between your in-the-money long strike and your short strike. So $5.50 minus $5.20 is $30. That is your max value, okay? And then your max profit is going to be that value is $30 minus how much you paid for the trade, okay? And we'll go in the actual example with all the numbers on the screen later. And also a butterfly spread is good when IV is really high. So IV is implied volatility, for those who don't know, and a high IV rank, which I will hereby refer to as IVR, so that's IV rank. So when IV rank is greater than 30, that means that premium is really, really elevated, and it is good to sell contracts for premium. And a butterfly spread is, it can be a debit or a credit play, right? But you are selling two contracts in the middle of strike. And so that is what we're trying to take advantage of here with a butterfly spread without doing naked selling. So basically, the other way that people view butterfly spreads is that it's actually a short strangle. And a strangle is a type of strategy that requires a really big move in the underlying to make money, right? So a short strangle is the opposite, where you're trying to pin down the asset and not that it doesn't move away from those strikes, so that both of those options expire worthless and you collect max premium. So that's what a short strangle is. A butterfly spread is kind of the same thing, but instead you now have protection because you have two long calls to protect yourself so that you have a max risk instead of being completely naked. And so that's the other way people view butterfly spreads. I prefer to view it as a debit spread with a that is made cheaper by doing a credit spread. So I reduce the cost of that vertical debit spread, right? But that's how I view it. And then now for the asterisks on neutral. So butterfly is neutral as long as it is within those strikes of your wings, right, at the base. the body, sorry, not the base. So in the case of Netflix example, that would be 550, right? That would be where we would be neutral. So all our regular butterflies are neutral. They can be modified to be directional. So while there are, if you are doing an at the money butterfly, in other words, you're selling those strikes at where the current price is, that means you are true neutral on that ticker. But if you shift all your strikes up or down, you are directional up to the point where that middle strike is. So that, I don't know if that makes sense or not. But this is different from, like, say, a long call or a long put, where you are completely directional. There is no neutrality at any point in the trade. You're either making money or you're losing money, right? But with a butterfly, you want to pin it to a certain price, and so you are neutral at that middle strike price. And then if that middle strike price is not what the price of the stock is currently at, or the other asset you're trading, then you are directional up until that point. So that's how you use butterflies for directional as well as neutral. Let's see, what else did I put here? So usually I'm going to be talking about debit butterflies, but there are also credit variations of the butterflies. I'll talk a little bit about them later, but I won't focus on that for the purposes of this seminar. I may do further seminars in the future that go into other types of butterflies, right? And directional bias is determined by delta. So remember, we talked about how delta is like owning X number of shares of the stock. It's also how much the options price changes per move in the underlying. If you think about it, it makes sense, because if you own 100 shares, right, stock price goes up by $1, then you get $100 more, right? Because that's how much you move. And with an options contract, because if your contract is deep in the money, then it gets really, really close to 1. And so at that point, it's almost like owning 100 shares of the stock. And so that's why when you have deep in the money contracts, delta is close to 1, because it basically means that it's almost like you're owning 100 shares of the stock. So I don't know, if for example, for Netflix, I'm sure if you pull up your brokerage account or something, and you go look at the lowest call strike, I don't know what that is, but let's just say it's $5 strike, I'm sure that the delta is going to be like 0.99 whatever, right? Like practically 1, because there's almost no chance that Netflix is going to go below 5. It's basically like owning 100 shares of the stock. And at that point, the premium of that contract is going to be almost the same as buying 100 shares of the stock anyways. So it's really not much of a difference there. But that's delta, okay? So directional bias is determined by delta. So basically, when you have a butterfly, you have a net delta because you're buying and selling contracts. So you add all those up. Whatever your net delta is how directional your play is. So that's an easy way to determine that. If you can do the quick math for yourself, or you can use an options calculator and it will just spit out your net delta at you, okay? An example of that is optionstrat.com, which we will be using later. All right. I'm going to catch up with chat real quick here before I move on to the next slide. Get any questions about, do you post all trades to your challenge account? No, I do not post all trades, but I do, well, let's put it this way. I put them all somewhere on the Discord, but I will not necessarily alert all of them. So, for example, it might be on the watch list, or I might mention it in chat, like in Swing or something, that, hey, I'm looking at taking this play. And then every weekend, I am putting out a personal butterfly watch list, at least until I am done with this challenge account. And that actually lists all the plays that I'm talking about. Yeah. So usually I take plays off of that. All right. So more questions. Is there a website? Yes, it's Option Strat. Sorry, I didn't finish that question. So for those people who are watching this later, or on another platform other than Twitch, because I know this is on YouTube as well. If you guys are on any of the other platforms, I am multi-streaming this to multiple platforms at the same time, but I am only going to be looking at the Twitch chat. So if you have questions, please drop by our Twitch chat to drop them. It's twitch.tv/Xtrades. And I am catching up questions here. But from It's Nasty Nate, is there a website where it grabs the butterfly for me? Question. And yes, that is optionstrat.com. We'll be going over examples using that later. Butterfly options can be used in bull or bear market. Correct. That question was by Trading Genius. So you can use it in bull or bear markets. You can use it in neutral markets. A very versatile strategy. You can use it in pretty much any situation. It may not always be the best strategy to use, but you can use it. Okay. And so that's what I want to explain again. Reiterating here, everybody's got a different trading style. What works for me may not work for you, and I'll explain why I do what I do and you know the reasoning behind it, as well as the pros and cons. But yeah, we'll get there when we get there. All right. I see a few other questions here, but they're all questions that I will answer later in future slides, so I'm not going to keep repeating myself. So let's move on. Okay, so long call put butterfly spread setup. So the first thing I want to do here is explain how to set up a butterfly. So for a long butterfly spread, this is just a vanilla butterfly. Okay? It can be calls or puts, doesn't matter. What the ratio of the setup is you're gonna buy one, I'm just gonna say call for this example, okay? Buy one call, sell two calls, and then buy one call. So you got your credit spread and your debit spread, right? Your debit spread is gonna be your buy one, sell one, and then your credit spread is gonna be the sell one, buy one, right? And so you add those two together, make sure those sold strikes are the same strike, right? If it's not, then you got a condor play, okay? I'm not going to talk about that. But buy one, sell two of the same strike, buy one, and that forms your butterfly. Have the wings equal distance from the center short strike. So make sure that they are the same distance. Both calls and puts have the same profit profile if strikes are the same. So for example, and this is why I keep using Netflix, is because that's the one I wrote on my slides. But for example, if I took Netflix July 16th and I bought to open, that's what BTO is, by the way, and STO is sell to open. If I bought to open one 520 call for Netflix on 7/16, and then I sold to open two 550 calls, same date, right? 7/16, and then I buy one 580 call for 7/16 for Netflix. That forms my long butterfly spread. Okay, so you see that it's the same distance between everything, right? 550 minus 520 is 30. 580 minus 550 is also 30. Width is the same. Okay, so that's an example of a directional butterfly, because actually Netflix is, sorry, I should clarify this. It is a example of a directional biased butterfly, right? Because it is a neutral strategy, but I add directional bias to it by shifting the strikes. Because right now Netflix is somewhere between 520 and 530. I don't know what it closed at, but I think it's somewhere like maybe 528, around there. So I'm directional because I want Netflix to move up to 550. Now, an example of a neutral butterfly is where you're going to be going long one in the money, sell two at the money, and then long one out of the money. So if, for example, Netflix was at 530 at close on Friday, yesterday, just for example, right? That's not what it closed at, but for example, if it has 530, then I'm going to open a neutral butterfly. I don't think Netflix is going to move much. Then maybe I'm going to open a 500, 530, 560. Okay, so same thing, same setup. It's just where your strikes are that determines directionality. And now I mentioned earlier that it doesn't matter if you do calls or puts because the profile is the same. So how do you decide whether to do calls or puts? Well, I put the answer here, but your short strike should be out of the money, right? Why do we want our short strikes to be out of the money? Because when you are shorting a particular strike in the example of calls, that means you're selling someone else the right to exercise those calls, right? So in this Netflix example here, where I sold to open to 550C, I'm selling someone else the right to buy 200 shares, because I have two contracts of it, right? 200 shares of Netflix at $550 each. And if that is deep in the money, say that Netflix is at $600 on Monday. Not saying it will be, but say for example, then this strike is deep in the money, and maybe that person wants to exercise a strike. Highly unlikely, right? But there's a chance. Usually there are certain case scenarios where people will want to exercise early. Usually people don't exercise early, but if somebody does, for example, and is deep in the money, $100, they were like, okay, I want to buy Netflix at $550 because Netflix is at $600 right now. I am going to make bank on this, right? That means that they can exercise their contracts, and suddenly me, being the short seller of those contracts, am on the hook for 200 shares because I have to deliver 200 shares to this person, and they're just going to pay me $550 per share. And currently Netflix is at $600. I do not want to buy Netflix at $600 to sell it at $550 because that means I would lose basically what the other person is gaining, right? So this is why your short strike should be out of the money, because if it's out of the money, then no one's going to exercise those calls. Say Netflix is at 530, which is around where it is at right now. If somebody decides to exercise 550 calls, which I have no idea why anybody would do that, but say they did, then they're saying, I'm going to buy, 100 shares of Netflix for $550 each times the number of contracts that they're exercising. And I'm going to be like, sure, why not? I'm going to buy 100 shares of Netflix times the number of contracts you have at $530, and I'll sell it to you for $550, free money, right? So there's no reason anybody would ever do that. But, just for illustration purposes, that is why your short strike should always be out of the money from where you're currently at. So basically, long and simple of it, calls or puts, just depends on what direction you are, same as when you're getting long calls or long puts. If you're bullish on a stock, get calls, because that means that you're going to be selling to open a higher strike. If you're bearish on a stock and you want to pin the price lower, which is what a butterfly is trying to do, you're trying to pin the price to your middle strike, right? Then you get puts, and then you get a strike that's below what the current stock price action is. So long and simple, we do short strikes, should be out of money, and we decide calls or puts, even though the profit profile is the same, if the strikes are the same, because we don't want the risk of assignment, however low that might be. And even in the case where you are assigned, I would say don't worry about it too much. That's why you have wings, right? So in this example again, 550 call, somebody exercises it, you're on the hook for 500 to buy 100 shares of Netflix to deliver at $550, right? No problem, because you have a 520 call that you can exercise and say, I'm going to buy Netflix at $520 and I'm going to sell it to you at $550. In other words, you just made max profit on that debit spread part of the butterfly. On the other hand, if both of your contracts are assigned, then, basically you're at your max loss, which is the debit you paid, because you can exercise your 580, right? And you can exercise your 520, and then you sell both at 550, then basically you're at a net zero. So basically you just lose whatever your debit part of the play was. You can never owe more than what you put into butterfly because you have wings to protect yourself. And that is why we do wings, because we want to short the options to collect premium. That's what we're trying to do. We want to collect that premium, but we want to make sure that we are defining our risk and not putting ourselves at unlimited risk, okay? And, I know naked selling and stuff gets a lot of bad rap, but in reality, if you have a really, really large account and you manage it appropriately, naked selling isn't actually that bad. But I don't do that much myself, but I know the folks at Tasty do it a lot. So if you want to learn more about that, I would follow up with them. So I'm gonna demo it on Option Strat just to show you what it looks like, so you can visually see it. Okay. I'm gonna pull that up right now, and while I do that, I'm also gonna read chat to see if there's anything I need to catch up on. Okay. Question: how far out of money can one get to be safe? I mean, really, with a butterfly spread, you're always quote unquote safe, because you don't lose more than what you put into the trade, right? All right. I don't know if that answered your question or not, but if it did not, just let me know. And I wish somebody told me this before, but I realized that every single time I've done these seminars, that it's been really, really difficult to see this option strat page because I had it super zoomed out, and that's because I wanted to see everything on one page. But when looking at it on a video seminar, it's so small that you can barely see it. So I'm just gonna zoom in here so you can actually see it this time. This is optionstrat.com. This is a butterfly on Amazon, and I'm actually not going to use this one because this is not a vanilla butterfly. So let's pull up another one here. I'm just going to use Netflix as our example because that's what we keep doing. Just for visualization purposes and keep it consistent, right? So we did 580, so I'm dragging, this top bar here represents the buys, and the bottom bar represents the sells, okay? So I bought 520, sold 550, bought 580, right? So 520, 580 is on top, and I sold to 550, that's why there's a 2 here. Another tip on option strat is you can change the quality of the options contract by clicking on the little flag of the price, or the strike, and then you can edit it. And it'll also tell you what the bid and ask is, as well as all the Greeks. So if you want to do any quick math, you can do that. And also, if you bought the price at a different price than what it is, and you already took the play, and you're not using this for planning purposes, but you already took it, and you just want to figure out, where you stand right now, what does it look like from here, then you can edit these prices as well to change it, fit what you actually bought it at. All right. Anyways, so this is what it looks like: 520, 550, 580. Profit loss chart. Why is this coming out as a credit here? That doesn't seem right. This is supposed to be... Oh, did I edit the price? Yeah, this is not 470. Why is it 470? Alright, there, we fixed it. I must have accidentally, I don't know, dragged 470 over to this price when I was clicking back and forth. I was like, there's no way this is supposed to be a credit play. Okay, so this is a debit play, right? If I opened it at closing price on Friday, which is probably not what it's going to be at Monday open, but if that's when I opened it, this play would cost me $815. My max profit is $2,185, and the reason again for that is because your max profit is going to be the distance between your short call and your long call, right? So it's 550 minus 520 is 30, so that's $3,000 minus the amount you paid for the play, which is $815. So your max profit is $2,185. So I know people always get concerned when they start thinking about spreads when they're coming from just long calls or long puts, and you're like, but I'm limiting my profits, right? I can't make as much money. But the thing is, most of the time you're not going to be making exorbitant amount of money. There are exceptions, of course. For example, this past week, if you took Tesla calls or space calls or whatever, those stocks blew up, right? And they went sky high, and then some of them retraced a little bit. But if you got into calls early, you probably made a lot of money. But those situations are, they happen often enough, right? But most of the time you're not going to be able to catch those kinds of plays. And this is why we do spreads, because most of the time we're not going to be able to achieve those kind of crazy gains. And with these limited risk strategies with spreads, where we're limiting our risk, more so than if I just got a long call. For example, if I got a long call on Netflix for 520, it would cost me $15.88. This play right now only cost me $815. That's half, about half the price. As long as Netflix doesn't go over 550, this play would actually net me more money. So that's the point, right? You can set up the strikes in a way to make more money with spreads. There is going to be a strike that expires worthless, right? No matter what. How many strikes expire worthless every week? Tons. If you're not taking advantage of that by selling it to somebody else against your long call, I'd say you're missing out on money. Sometimes we might not be right in which call we think is going to expire worthless, right? It's a balance between, how far out do I want to sell and how much premium I want to receive. But, a lot of times you're going to be making more money more consistently with a spread. All right, enough about my soapbox spiel about spreads versus long calls and long puts. Not saying that long calls and long puts aren't good, because they are good, but they are better used for day trading and very, very rapid moves. That is when I would use long calls and long puts, and I do that as well. But most of the time, if I'm swinging anything, I am going to be using a spread, because if you're swinging something, you have a lot of overnight risk, and you know, why not? You're gonna have theta burn as well. Take advantage of it and sell something to make theta be on your side instead of against you, right? Soapbox over. So I wanted to pull this up because I just wanted to show you guys the difference between a long put butterfly and a long call butterfly. And I made a mistake there. I wanted to make a new tab. So long call butterfly looks like this. So you can view it here as a table, but you can also view it as a graph. So this is at expiration. Before expiration, the profit profile looks very different, right? You gain more towards expiration because for a butterfly play to achieve max profit, you need it to be at this certain price at expiration. And that's because you're selling options contracts. You have these two sold here. And this is not going to go to zero until, you know, the last couple days of the play, right? And so that's why for a butterfly, you will always see that. Let's blow up this chart range a little bit so you can visualize it. So you see, if you go too far, you start losing money. If you drop too much, you start losing money. You're really trying to pin it to this peak area here. Okay, and you see that the further right you go, the more money you make, even though the price is the same. And that's because you're collecting data. So this is why sometimes, you know, playing the time, choosing the right expiration date is also valuable for a play. Not that you don't make money if you play further out, but, you know, after a certain point, it's like, not really sure I want to play this. There's probably a better strategy out there if I expect a $550 move in 1 or 2 days. For example, getting a vertical spread or even long calls, right? If I'm expecting it to move up soon, a butterfly strategy is not the way to go. But, you know, finding the right expiration is really important for a butterfly spread. All right, anyways, graph. So this is what it looks like at expiration. Okay, I'm gonna zoom out again, move along the time to expiration, so you can see it. So this is what it looks like at expiration. The break evens of this play is 528 and 571.85, which is basically your long strikes, your wings, plus or minus your debit paid. That's basically how you get this number. If you've been playing options for a long time, you probably already understand how to do that in your head in a snap. But 580, so we're going to look at the put butterflies of the same one with the same strike. So if you notice, net debit is $840. Net debit here is $815. So it's actually a little bit different. And that's just because, you know, sometimes the IV on calls versus puts is a little bit different, and liquidity is a little bit different on plays. I'm going to switch to bid and ask just to see if there's any difference there. Yeah, so you see here, the liquidity on the puts is really, really bad. So mid and bid and ask is just what you're buying the strikes at or what the options calculator is using to assess the price. And if you're doing bid and ask, then it's assuming you're buying, you know, at the ask and you're selling these at the bid. And so that's why there's such a huge difference, because puts usually don't have as much liquidity or volume as calls do. Pretty much almost all the time for any ticker you find, that's pretty much always the case. People like to play calls more than puts, right? I do too. That's just how we're wired, I guess. But that's why you notice such a big difference between bid and ask and mid on puts, while you don't notice a difference in calls. $60 difference here, and you got like a $300 difference on puts. So calls has better liquidity. But, you know, we see that they're about the same price. I mean, like, there's just like a $25 difference. But I think that's just because the liquidity is so bad on puts. But you see that the profit profile is about the same, right? 2,160, 2,185. That's just the difference between the debits here, because this one costs a little bit more for the puts. And your break even is, you know, about the same again, because the profile is exactly the same, okay? Right? There's no difference. So Just wanted to visually show you guys. I know this was a really long rant. Alright, but basically calls puts the same. The only thing that decides whether you should do a call or put is if you're bull, do calls because you want to sell a strike that's out of the money. If you're doing puts, that's because you're bearish and you're selling a strike that is below current price. Okay. Done with that. Desktop app, and I got a question from SR and Broke. I don't know if that was from you, but somebody was asking about desktop app or iOS app. They are the same. You can use both of them. So Option Strat does have an app on the phone or mobile. That is really handy if you do a lot of trading on your phone. So I know somebody was asking about is it estimation or not, and yes, all of these things are based off of gee, I'm blanking out now, but it's based off of a formula. I should know what the name of it is. I forgot. But there's a really common formula that we use for options pricing, and it's Black-Scholes model. Okay, Black-Scholes model is BSM. So at least I think it's BSM, but Black-Scholes model, and that's is a model for how options is priced, and that is what these options calculator is based off of. It is not a perfect model, but it gets pretty close to the price. The one sticking point about Black-Scholes model is that it does not do so well because there's an unknown variable, and that's called IV. IV is unknown. Okay, IV can change, and when IV changes, it changes the options profile. Not at expiration, because IV is 0 at expiration, but if you look at the table here, right? So if I change IV, then you see that, the price changes. And IV is something we cannot predict, because IV just represents demand, supply and demand for a certain options contracts, and that is not something that we can predict. But yeah. So this goes back to one of the points of why we use butterflies, and that's we use it in high IV environments. And the reason is because when IV is high, butterflies become really cheap, and that's because we're selling 2 strikes, right? So we're collecting more premium on that, so the butterfly spread is cheaper. And then on top of that, when IV is high, usually that means that, over time, IV is supposed to drop back down. And if you are within range of your play and IV starts dropping, notice how you achieve max profit much quicker, right? Suddenly, if at $550, I'm making $1,283 on this play. Whereas if IV was higher, or where it is at right now, you'd only be making $358. But if suddenly IV dropped, you'd be making more. So this is why we like to play butterflies in high IV environments. Okay, they're cheaper to play, cheaper to open, right? And then you make max profit sooner. So that's why we do that. All right, next slide, breaking down the numbers. So, I repeated this a lot of times throughout this, so I'm not going to go through this slide, but this is basically explaining, how you get the profit loss thing, right? But I explained this while we were going through the examples earlier, so I won't be going through that again. But I'll have this slide in here if you guys want to pause the video later to watch it. Pros and cons of butterflies. All right. So primary advantage versus long calls or puts and or vertical debit spreads. Okay, so it's cheaper to play, right? Why is it cheaper to play? It's because we're selling 2 contracts, right? So I know in that Netflix example earlier, remember for that long call, if I bought that 520C for $7.16 for Netflix, that would cost me $15.80 at close on Friday. But to play the same butterfly, it would only cost me, what was it, $815 or something like that? So that's almost half the price to play. So it's a very high reward to risk play, and the reason is because we have low risk on butterflies. And what risk is? What is risk? I know a lot of people confuse that with like probability. How likely is my play going to pan out, right? Sure, when we say something is risky, we go like, okay, maybe that's not going to work. But really what I'm using risk here to mean is how much you are risking on the play. In other words, basically how much the play is costing. Because with these kinds of plays, your only risk is your debit, how much you put into the play. So in that case of that example for that Netflix is $815. And if you remember on the calls, $815 to $2,185 is our max profit. So this is like a, I don't know, maybe like a 2.5 to 1 ratio. I was close, okay. 268%. So that's our max gain. Not bad, right? Like I can double to triple my account if I play all the way up to expiration, which may or may not be a good idea. Okay, but that's the potential. There's the potential to make that much. So it's a very high reward to risk play. Primary disadvantage. So with that said, when you have low risk, when a play doesn't cost that much money, that also means that it's a low probability play. I don't know how many times I've seen people buy far out calls for like really, really cheap. Like, oh, you know, it only costs like 50 cents or whatever, right? And I'm like, well, sure, but chances are, you know, that call is going to expire worthless, right? There's low probability on that play. That's why it's so cheap, because all options are priced in reality. We're just trying to apply our bias to the market to try to get an edge, and that's where we're trying to make the money from. Because in reality, all options are priced based on probability. How likely is this play going to pay out, right? And that leads me back to another point. I know I'm backtracking a lot here, but this goes back to delta. Delta also roughly represents the probability of a play going in the money. If your play has a delta of 16, that means there's a 16% chance, roughly 16% chance, that play is going to go in the money by expiration. That is what delta represents too. So if you know, like some brokers tell you what the expected move is every week for a certain ticker, if you go and find the call that is 16 delta or 0.16, same thing, and you find a put that is 0.16 delta, that is what the actual expected move is, approximately. It's really, really close. So, and what does 0.16, why is that important? It's because if you guys have studied stats or no stats, then you know that 0.16 is going to be represented by more than one standard deviation move. So plus and minus one standard deviation, that is your 16 delta, approximately, right? Because, you know, one standard deviation is 34% on each side. 34 plus 34 is 68. And then what's left over is 32%, right? 32% is a probability that a move happens outside of one standard deviation. And then you divide that by 2 because you have both sides below and above the stock price. So that's 16. That's my little stats lesson for today. So it's a low probability play because it's cheap. Limited profit, right? If you took calls on this Netflix play at 520 and I don't know, say that it goes to $570, if at expiration this will be worth $50, right? 570 minus 520 is 50. That's the difference. You're making $50 on this play, minus $15.88, so that's, I don't know, $34, $35, right? So that's how much your net profit is. But on this play, I'm capped. I can't even make $3,400, which is what the other guy would make if it goes to 570. I can only make $2,185 on this play. And if it goes to 570, it's even worse because now I owe money because my credit spread is owing money, right? So 570 minus 550, because I sold these strikes and someone else is making this money, right? 570 minus 550 is $20. That's how much I owe the other guy. But on the other hand, my debit spread, 520 and 550, you know, I'm making max profit on this because 550 minus 520 is 30. So I owe somebody else $20 and somebody else owes me $30, and in the end I make, you know, the value of my play is $1,000. So I make $1,000 minus 815, and I only made $185 versus the other guy who got long calls. If Netflix is at 570, they would have made $3,000. So that is the limit of a butterfly, right? Still profitable, but not as profitable as calls if things are really bullish. And this is why you use butterflies if you're neutral bullish or neutral bearish. If you're super bullish or something like that, you can do a vertical spread or something else, right? But of course, you know, if you feel confident in being able to pin, like for sure, there's resistance at Netflix at $600. It's probably not going to go over 600. Then, why not open a butterfly for that strike, right? And that is what we're trying to do. We're trying to say, like, okay, on the chart, there's a lot of resistance in this area. I don't think it's going to pop over this area immediately. Maybe it might pop over, after consolidating under 550 for a bit, and then it might make a run to $600 or something. That's something you're going to have to assess on the chart. But if you are able to essentially guess, right, or predict those prices accurately, the butterfly would pay out more than an equivalent call spread. Okay. Chance of getting a sign earlier, Soul Strike is in the money, so we mentioned that already. So now we know that, it's a low probability play, and I like to use an analogy here with the dartboard. That's why this dartboard is here. Basically, with a butterfly, we are trying to pin the price to the short strike. I keep saying that, right? So that pin is this dot right in the middle. What's your chance of hitting that dot? I mean, if you're really skilled, maybe you can hit it 10 out of 10 times, right? But for most people, if you've never played darts before, or you don't do it regularly, and say that you're really far out, you'd be happy if you hit anywhere on this board, right? At least for me, I'd be happy with hitting anywhere on this board. So let's just look at this butterfly. Say that the edge of this dartboard is basically where your wings are. Say that this 11 over here is 520, see? This 6 over here is 580, okay? And then this middle strike is 550. And then the other axis is, you can just consider it time, right? Because you need to be accurate on time as well, because you hit max profit at expiration. So that's my dartboard analogy. Now, think about it for a second, and if the dartboard is closer to you, are you more likely to be able to hit that center, or are you more likely to be able to hit it if it's further away from you? I think for most people, at least up to a certain point, if it is closer, you're probably more likely to be able to hit the center dot, right? A bullseye, or a 550C in the case of Netflix, than if it was really far away. And so that brings me to a point. I'm going to shift this over to a neutral butterfly. Say that 500, 525, 550 for a neutral butterfly. So this play costs $850. I can only make 1,600. Alright, so I changed the strike. Notice what happened here. Why is this play more expensive on July 2nd than July 16th? I'm paying $300 more. Why? Isn't it normally that when you buy further out, plays get more expensive? Look what's happening. It gets more and more cheap. In fact, if I go all the way out to March 17th, 2023, I didn't even know they had it cost that far out. You get a net credit of $358. They're actually paying you to take this play. I just realized there's something broken here. It's because they don't have those strikes. Let's fix that. Okay, January 23rd, okay? January 20th of 2023. So a couple years from now. You're still getting net credit, right? $15 net credit. That's your minimum profit. You can't even lose money on this trade if it executes. In reality, you probably won't execute at that price because there's probably the bid and ask is probably really wide, right? But just for visualization purposes, because we're just comparing mids for all of these, as you go further out, it gets cheaper and cheaper. Most of these weird random pricing is because of the wide bid and ask. But basically, the further out you go, the more cheap it gets. Until at some point, it's like the calculator is calculating that you get a credit, even though it's unlikely you'll get a credit because the bid and ask is so wide. But why? And that goes back to my dartboard analogy, right? If I place this dartboard 1 mile away from you, and you're just throwing darts, you're not using a sniper rifle or something, right? You're just throwing darts. How likely are you going to hit this? Probably little to no chance, right? That's why it's so cheap to play. And on the other hand, if you move the dartboard closer, you get a closer expiration, you are more likely to be able to accurately gauge what the price of Netflix is going to be in a 1 week period over a 2 week period. Like, if I go out a couple months, I'm going to be like, anything can happen in the market. Maybe, I don't know, we go to war or something. Whole stock market crashes. Or maybe, I don't know, we get another big stimulus for banks, and they decide to not to lower corporate tax rates or something like that instead of raising it. And suddenly the market skyrockets. Anything can happen in those couple months, and this can bring us out of this butterfly range. And that is why it's so much cheaper to play further out on butterflies than to play up close. Okay, so that is my dartboard analogy. Take it as you will. Hopefully that helps explain some things about butterflies to you. Low probability of success, especially to hit this center strike. But you know, most of the time, I'm pretty happy if I can hit anywhere on this dartboard. If I can hit anywhere on this dartboard, I'm making money, and if I'm making money, that's all that matters. Don't try to aim for the bullseye all the time, because chances are you're not going to hit it. And then my other analogy here is, on dartboards is, if you make your dartboard bigger, are you more likely to hit it? The answer is probably yes, right? So, if we widen these strikes out, the play is probably going to cost more, right? I didn't even measure out how far these are, but let's just do, I don't know, 450, 520. So how much is that? $70. So I need $70 up here, so that's $590. So this is a $70 wide butterfly on both sides, or $140 total width. So this play cost me $4,700, a lot more than what the previous play cost me, right? Before it was costing me $800, and that was for like a $25 wide spread. 25 on each side. So $800 or however much it was versus $4,700. This is a heck of a lot more expensive, but you know what? Your break even is also a lot wider. This is a much more higher probability play, but your profit is less relative to the max loss or the net debit. So the more you put into the play, the less you get out of it in terms of relative profit, but the more probable it is. And that's because your dartboard is bigger. It's easier to hit. How do you want to play it? I don't know. It's up to you. You know, this is trading style, your risk tolerance, and your preferences. I'll tell you in a bit how I play it. But for visualization purposes, I hope this dartboard analogy helped you guys. All right, so wing width. This goes back to that dartboard analogy on how big it is again, right? So you have two components, your debit spread and your credit spread. Those are called the wings of the butterfly, right? The short strike is the body of the butterfly. Importance of wing width, again, this is repeating what I just said earlier with that dartboard analogy. A narrow butterfly or a small dartboard has a low probability of success, lower risk. And the reason why risk is lower is because risk is how much money we can lose. Because it costs less, so that's why it's lower risk. Also lower return. Why is it lower return? Because, you know, the chance of you returning a big number is really small. So it's just expected value, right? Of course, your percent gain is going to be a lot higher for a smaller and narrower butterfly, but the probability of hitting that is a lot lower. So most of the time, it's going to be expiring worthless, and you're just losing the $50 you threw in a really narrow butterfly or something. A wider butterfly, higher probability of success, higher risk because it costs more. We're paying, again, in that example, $4,000 versus $800 to make it, you know, $50 wider or something like that. But also higher return because you have a higher probability of success, higher chance. And so again, I just asterisk here what is risk, and that's just because I know a lot of people confuse and mix up with being probability of outcomes, but it is in here. I'm using it to represent the amount of money we can lose. That's how much I'm risking, right? Okay, I think this covers this segment of the seminar. So I'm going to really quickly read up on the chat here and see if I missed any random questions. I know that there's been a lot of questions being asked, and I want to thank everybody who's been answering questions. I noticed 007 answering a lot of questions, Shen Moon's answering a lot of questions. I think Roy's dad is in here as well. But yeah, thanks for answering questions, guys. Somebody's asking about the benefit of butterflies over traditional credit or vertical spread, and that's just because it's cheaper, right? It's cheaper. If you're talking about credit spread, that's a little bit different, but you also have a debit portion of it, and that actually makes me able to earn more. With that debit spread, I can win more than I would if I had a credit spread. right? So the disadvantage of a credit spread in that case is that, you know, for a credit spread, all you can collect is whatever you collect up front. A debit spread has more potential to make money, and with a butterfly, we are offsetting that debit spread cost with a credit spread, and that's why I like it. Somebody was asking more expensive or less expensive than buying a single long call. This might have been a while ago, but basically, because I answered this during our presentation, but it is cheaper, right? Butterflies are cheaper to play. Robinhood isn't letting you add 2 calls at 550. Make sure you have advanced options, enable options level 3 to do these kinds of plays. And also, after you select all the strikes, you need to customize the ratio of the strikes. I don't want to get into too much into that because that's more brokerage type stuff. From Frostpeld, TimeHawk, can you please give an example of a butterfly play to try out next week? I'll give examples later, a demo later on how to do that and what's optimal to play. All right. I don't think I'm going to answer most of these questions because I will be answering them later. Or I'll have slides later that answer the questions. So, does changing IV affect butterfly spreads? Yes, we answered that. I think I probably went too far back in the chat because I answered a lot of these questions. Can you do butterflies on a cash account or a margin account? You do need a margin account to do it. How to identify good tickers to play butterflies? We'll be going over that later. All right. I think there's too many questions in chat. I know I didn't answer everybody, but I will be taking questions and answers at the end if you guys still don't know how things are working out for these butterflies, because I still have another 5 or 6 slides to go, right? I think I'm about halfway done. So hopefully the rest of the slides will answer your questions. Thanks for bearing with me, guys. All right, next slide here. Butterfly variation. So far we've just been talking about vanilla butterflies, which is a long call or a long put butterfly. So there are other types of butterflies, and this is not an all-inclusive list, but it's some of the ones I felt were more important or the ones I see more often. We got broken wing butterflies here. I'll be shortening it to BWB. But they're also called skip strike butterflies or unbalanced butterflies. And that's because one of the wings, you got your credit spread and your debit spread, is larger than the other. When your debit spread is larger than your credit spread for that width, then it's called a debit broken wing butterfly. And then when your credit spread is larger than your debit spread, that is what we call a credit broken wing butterfly. And that is the traditional broken wing butterfly. Usually when I see people play broken wing butterflies, they are usually trying to play it for a credit, and that's the common way of playing it. We do use a lot of debit broken wing butterflies in our Discord though, and that's usually how I am playing broken wing butterflies. Credit is also a totally valid move, and I think is a good way to play it as well. But I think most people's accounts are better suited for debit broken wing butterflies because it's easier to understand and manage right now. If you do have larger accounts, though, go and read about credit broken wing butterflies. Christmas tree butterfly. So it's similar to the debit skip strike butterfly or the debit broken wing butterfly. But what it does is that it has an additional credit spread. So it's a 1:3:2 ratio. And I'm going to have to show you guys this on option Strat so you guys can visually see it, because I think it's kind of hard to understand just from reading the text. But a Christmas tree butterfly is when you are more bullish, okay, or bearish. You want to have more direction on the play while collecting a little bit of extra credit to reduce the cost of that directionality. Same thing with broken wing butterflies is that unlike a regular butterfly, a broken wing butterfly carries a little bit more directional protection. Because by breaking the wings of a butterfly, instead of having it be where like a normal butterfly where we're trying to pin it to a certain price and we have that tent in the profit chart, right? If you remember, I'm just going to show it to you guys. So if you have a tent, right? You can only make profit on this butterfly between 497 and 552. It has to be between here. This is our tent of profit. With a broken wing butterfly, you eliminate risk on one side. So I'm just going to show it to you right now. So for example, right now my credit spread is $70, right? So if I want to do a credit spread, then I'm going to make my debit spread smaller, and I make the credit spread larger. And okay, I'm at a credit. Great. Alright, I'm not saying do this, guys, but just for demonstration purposes, right? So 510, 520, that's our debit spread. Really small debit spread here, and a wide credit spread from 520 to 590. So what this does is that we get a net credit on this play. We pay we don't pay. We receive $782 for taking this play. And our max loss is now $5,218. This is our additional collateral for the play. And the reason for this is because we got a credit spread running over here, right? So if Netflix goes all the way up to $590 or higher, we're on the hook for $5,218. Technically, it's basically $590 minus $520, $70. That's we owe somebody $70, right? And then we have this debit spread to neutralize some of the cost, but this is only a $10 wide spread, so it's $70, $590 minus $520, and minus this debit spread. So that's $10. So then we get $60. So that means that our max loss is $6,000. But then we have the net credit we receive for opening the play of $782, and then we end up with $5,218. That's how you get this max loss, right? So because your credit spread is so much wider than your debit spread, we have the potential to owe money, but we get credit for the play, and it's called a call broken wing. And what this does here is you see that we protect ourselves from downside. That means that if you are, maybe you're bearish, you can do this, right? Because that means that if Netflix drops, you collect full max amount of the net credit, $782. That's what this 100% represents here. It's not representing, including the collateral, which is usually how I like to play it. I like to use percent max risk. Because in reality, I am out $6,000 on this play, minus the credit. Because that's how much I have to keep in reserve in my account if this play goes south. Not saying it will go south, but in case it does. But yeah. So you profit $782 if it goes anywhere past, below, right? And then your break even is 537.82. But of course, your max profit is always going to be where you sold the strikes, which is 520. That's where we want to be. But if you think that maybe the market is going to go super bearish, but you think like maybe there's support at 520, and you're like, okay, I'm bearish on Netflix. I think it's going to stop at 520 on 716. So I'm going to take this butterfly, but I want to make sure that maybe I think that the market might have potentially just completely break through this support on Netflix, and I want to protect my sound side, right? Because before, if you were doing the whatever, you would start losing money if Netflix broke down really, really far, right? So to protect yourself from that, you can do this, and you get 510, you can do this call broken wing, and you protect your downside. So that's all a broken wing does, is it protects one side of your trade. On the other hand, you can also play this in a different way. And I wish I made slides on this, but there's so many topics to cover. Alright, there's a different way to play this, and that's if you play out of the money, bullish, call broken wing. I don't know if I can do that with this, but I'm just trying to mess around with the numbers here to try to create something that does that same effect. So you can see that I shifted the strikes up, because Netflix was at 527.42 at close on Friday. So say that on 716, I think that Netflix is going to go to $550, right? But I'm also like, ooh, the market is at all-time highs. What if we, crash or something, or the market decides to pull back and we don't go up to 5? Netflix drops to 450 or something, and I want to protect my downside. This is the way to do it. You can use a call broken wing, out of the money call broken wing, right? So now that my max profit is still at 550, I gained $1,000 on this play, and I collect an $84 credit on this play. My max loss is $2,916 if it's over 590 or above, right? But if Netflix drops below 540, or it just keeps going down, for example, I don't lose on this play. That's because I collected max profit on this credit spread, remember? This credit spread we're collecting max profit on as long as it's below 550. We don't pay anything to this person that we sold this credit spread to, right? And because we are protected by this credit spread, basically we don't lose money down below. So this is a way to play if you are bullish up to a certain point but want to protect your downside too. But the downside to this kind of play is that, oh boy, if Netflix is actually really bullish, it's going to be a little bit painful up here, right? Like, once you break over 530 early on in the trade, you start losing money. And then it slowly creeps its way up to, 550 by expiration. And that's just because your credit spread is so large. Whereas if you did a normal butterfly spread, 510 would be a regular butterfly, right? You actually have leeway above up and above 550, right? Like if it goes above 550, no worries. I can still make a little bit of money as long as it doesn't go too far. And then it slowly narrows the range as you get closer to expiration. And that's just because of the way these short strikes work, right? The dynamics of the Greeks. But basically, with a broken wing butterfly, you are biasing your direction significantly, okay? And the main purpose of it is to collect the credit on the play and to protect one side of the trade so that you're not losing on both sides. Which you do with a regular butterfly, you lose on both sides of the trades, and you just have to pin it. Profit is also higher though on a regular butterfly. But again, going back to probabilities, it's a heck of a lot harder to nail that strike on a low-cost play. So, even though the possibility of profits, not a possibility, there is a possibility of higher profits, the probability of hitting that higher profit is not necessarily there. So that's why a lot of people do broken wing butterflies, is because it's more probable to get profit, but you may not hit as high of a profit, but at the same time, a lot of times, you could hit the same profit. You just have to assess every single trade, manually figure out what's best for you using what you expect of the price action. That's how you should always play your trades, is what you think the price action is going to be. Do I want to protect myself from downside risk? Do I want to protect myself from upside risk? Where do I think the stock is going to stop? How wide do I need to make this to make sure that my play is going to be profitable within that range? Where is support and resistance? Those are the kind of questions you want to ask yourself before taking a play. All right, I think I went into a little bit more detail on that than I expected to. Christmas tree butterfly. So Christmas tree butterfly is the same thing as this. Let me try to get my mouse on here. So a Christmas tree butterfly is the same as a debit broken wing butterfly, right? Except that you're adding an extra credit spread. So this is what I normally play. I normally like to use regular butterflies, which is equal width on the wings, or debit broken wing butterflies. So this is the opposite of the credit broken wing butterfly, and we're going to shrink the credit spreads, right? So I'm going to make it 570, for example. 510, 550, 570. The top wing is about half the size of my bottom wing. And again, I know a lot of people are probably going to be asking, well, how do you decide how wide to make each strike, right? Again, it's just dependent on one, price, support and resistance areas, right? For choosing the middle strike. And then how wide you want to make these wings is, again, probability. How comfortable do you feel playing this? If I feel less comfortable playing this, right, then I might just choose to do a regular butterfly. Because remember, regular butterflies are cheaper to play. If I shrink this credit spread, I'm going to be paying more for this trade, right? So it's at 590. Look, it cost me $1,450 to play this. If I move it to 570, it's cost me $1,554 to play this. And if I go even further to 560, it's $1,651. So that means I'm paying about $100 extra for each increment. This, of course, depends on the ticker, right? You have to assess on each ticker, is it worth shrinking this or not? how much of a difference, how much am I paying, and how does this affect my bottom line, right? So the more I shrink this debit broken wing butterfly from a regular butterfly, as I shrink this credit spread down, the more I pay for the play. But on the other hand, look what happens to our profit chart, right? Do you notice it getting more green as we look to the upside, right? So when you do this, you get more of the vertical debit nature of the play and less of the credit nature of the play. And that's why it looks more and more like a vertical until you go to a true vertical, which is at 550. Because if you're buying and selling, this is basically buying 1,510, selling 1,550. This is the easy way to tell what a vertical spread would look like compared to your butterfly. So you're just varying, how much nature of a vertical debit spread versus a credit spread you want on your play as you shift these strikes. So you get a lot more money if you make a big move sooner on a vertical spread than you would a butterfly. And as a hybrid in between, by doing a debit broken wing butterfly, you kind of get the best of both worlds, and you also get none. Right? That's usually how it works. Can't get everything. You can go in between, but then you're just getting some of a little bit of both, right? So if you're really bullish on the play and you're playing a butterfly, then you can shrink your credit spread so that you get a more bullish type of play, but it still reduces the cost of your play as opposed to playing a vertical. Because if you're playing a vertical, it costs you $1,800, right? This just reduces the cost of the play. And if you're just getting a regular long call butterfly for not long call, just a regular long call, it would cost you $22.68. So it's all just a balance of how much do I want to pay, etc., right? How are you balancing and managing your risk? All right. Okay. I got off on a tangent again, but I was trying to explain Christmas tree butterflies, right? So the Christmas tree butterflies with this debit butterfly here, debit broken wing butterfly, it doesn't say that on option Strat because they don't identify what a broken wing butterfly is as a debit. They only know what a credit broken wing butterfly is. So you won't see it say that up there. But with a Christmas tree butterfly, you're skewing your play even more by adding another credit spread. So this just reduces the cost of your play, but you want to skew your graph like this. Yeah, I think it's probably easier to visualize on the graph. Should have done that earlier. But you're still trying to pin it to 550, right? But it makes your play cheaper than if you just did a regular debit butterfly. So let's go back. So I'm going to add one here and subtract one here. So notice that the curve changed a little bit, right? It was a little bit more steep before. Not steep. More of a, I'm doing the wrong way. More of a gradient. But it tilts your curve more. And this basically makes it a cheaper way to play a debit call butterfly. But at the same time, if you go above your tall strike of your debit call butterfly, which is a point, because when I play a debit call butterfly, it's when I am bullish on a stock, but I think that there's a chance that it may continue to run. This is what I've been doing all this past week, is I've been playing mostly debit broken wing butterflies. Because the market is so bullish, but I'm like, I still want to play butterflies because I want to limit my risk. So I was playing these broken wing butterflies because I was like, okay, even if it passes, my ideal strike, 550, for example, I would still make money. I just won't make as much, right? I make $496 on this play. Not bad, right? I still win. I would make most if it was 550, and that's what I want ideally. But it's okay. That's the price you pay for limiting your risk. But if I did a regular call butterfly, or I keep mixing up my terms. If I just did a debit broken wing butterfly, not a Christmas tree butterfly, then, if it passed my point, I make more, $1,349. But it also costs more. So all of these different variations of butterflies is just a matter of balancing how much do I want to risk on this play, what do I think is going to happen to the stock, is it going to break past my expected resistance point? And if so, do I want to protect myself from that scenario? Or am I more afraid that the market is going to drop? And if I'm more afraid the market is going to drop, maybe I just go with a regular butterfly. right? So that it costs me less, so that if it does break down this way, I lose less money because I put less money into the play. This is how I decide whether I'm going with a broken wing butterfly or a regular butterfly or a Christmas tree butterfly. It's just how directional I am. How do I want to protect myself from more downside protection, or do I want to protect more upside protection? And if I am more bullish on the stock, do I want, to make sure I make a minimum amount? Say I want to make 100% of my play if it breaks over 550, or if I'm okay making like a couple $100. That is what you should be using to determine what your strikes are. There is another way to assess these things, and that is by using the Greeks. Okay, so I don't really want to talk about that in this session. But general rule of thumb is when you're selling a strike two, other than using a resistance point, another good way is to look at the delta, because remember, delta is a probability that these strikes are going in the money, and you don't want your sold strikes to go in the money because you want to collect maximum premium on it, right? So usually the recommended deltas for selling strikes is going to be around 30 delta. Why? Because that's the most well-studied delta, and people use it a lot, and so it's been proven. But another good delta to pick other than 30 deltas, or in this case negative 30 deltas because we're short it, is the 16 delta. And why? That's just because it's one standard deviation above the current price, and so it's most likely going to be expiring worthless. So that's another way you can choose to do butterflies. You can play completely by the Greeks, and you can ignore, the charts and whatever. But I like to use the charts. I also look at the Greeks sometimes too, but most of the time I find that if I am basing it off of the charts, in reality the delta is actually pretty close to 30 delta actually. Not always. Depends on how directional I am. But I prefer to play off of the charts rather than just based off of delta alone. I know there are people who do play off of Greeks alone, and that works really, really well as well, because you are not trying to predict market movement at that point. You are just strictly playing probability and statistics, and over time you will win if you position properly in those kinds of plays. I am a different type of player, and I try to predict the markets, sometimes successfully, sometimes not, but when I am right, it pays off big, and that's just how I play. No right or wrong way to trade, just find a trade style that works for you. Alright, enough about Christmas tree butterflies. Iron butterfly. So iron butterfly is, you probably heard of iron condors before. So an iron butterfly is like an iron condor, except you are pinning it to one spot instead of a range where you can have max profit. I don't really want to talk about this too much. But it's basically, instead of having all calls and all puts, you have a bull put credit spread and a bull call credit spread. I don't even know if I wrote that correctly. But basically, it's like an iron condor, except that you, instead of having your spreads separate from each other, you have the center strikes on the same. So that's really the difference between a butterfly and condors. There are also long condors and stuff like that. We'll go over that in a future seminar. Visualize an option strat, we already did that. So when to play debit butterfly spreads. And I'm going to try to catch up with chat real quick. I'm not doing a good job with following up with chat. Can you review how good it would be to play MVI's debit spread? We can go over play examples at the very end, and you guys can send me charts or tickers that you want to learn about, or not learn about, but get a good setup on. So at the end, when we start doing charting, feel free to drop tickers that you guys are interested in and want to see an example of a butterfly on, or any other type of play, right? It doesn't have to be just butterflies, but that's what we're focusing mainly on for this seminar. Okay. So SNR broke. I know you're having a little bit of confusion here on having to own shares to sell strikes, and with other types of spreads that are defined risk. Okay, defined risk strategies. You can own 100 shares to sell a strike, right? That's totally fine. But in this case, our spread is because we own a 510 call. I am buying a 510 call and I'm selling a 550 call. Okay? I don't have to own 100 shares of Netflix because I own a 510 call, and that gives me the right to buy 100 shares of Netflix at $510. At any time, I can exercise this 510 call to get 100 shares, and then I'm selling someone else the right to buy 100 shares at a higher price. So there is no real risk in this trade. I don't need to own 100 shares because I own the right to sell 100, I own the right to buy 100 shares, and I'm just selling someone else the right to buy that 100 shares. So it's the same thing, except the price of that contract is different. So this is a replacement for 100 shares. That's what we're paying the premium for. This is a substitute. Any contract is insurance. It is a substitute for owning 100 shares or being short 100 shares, depending on, calls or puts and whatnot, right? So that's all it is, right? You don't need to own 100 shares to sell calls or puts or whatever. Well, if you're selling puts, you're saying you're going to buy 100 shares, but that's a story for another time. But yeah, you don't need to own 100 shares to sell calls if you own another call strike. You just need to have, if you're doing a credit spread, then you need to own the money to cover the difference between those strikes. But if you're a long call, then it doesn't matter. Alright, hopefully I explained that question to you. Okay, question. I know a lot of people are also misspelling my name. It's TimeHawk, TimeHawk. But that's not that important. From your last 3 months of play, which one gave you the highest return or max loss? And the analysis behind which really help us. Yes, I'm going to go through examples later. Would be interested in Baba that you played this week. Actually, I am going to go over Baba in a couple slides, so stay tuned for that. That's one of the examples I'm going to use. We're almost done with the theoreticals. Okay, we're about to get into practice, and that's hopefully more interesting. I know this seminars are a little bit long, so you guys are probably starting to snooze off too. Ham Fam, I don't know if that's Hamgo or somebody else, but will you show us how to close them? Yes, I will show you guys how to close them. Should you hedge with an in the money put? You can hedge however you want. If a play is going up and you want to protect your butterfly even more, I'm going to show you guys that actually. So say I'm in a regular butterfly. Netflix again, because it's just easiest to not have to change things, right? So say that I'm in this Netflix 510, 555, 90 call long call butterfly. Okay. Say that we are at $540, and now I am afraid, or say that it's not at 5, it's past 550. Let's just say that. Say that it is Tuesday, July 6th, and we are at $554. So right now I'm up $819, right? This is the perfect sweet spot. If we go across this line and the stock price doesn't move, I continue to gain money. If we move down a little bit, as long as we stay, as long as time keeps passing, data works on my side and I continue to collect money, right? As long as I stay within this range, I continue to make money. That's good. But let's just say that Netflix looks like it's going to keep breaking out past 550 because now we're over my middle strike. And if we keep breaking out, after a certain point, I'm not going to be able to make more than $819, right? So if I look at expiration, my cutoff is probably somewhere between 571 and 565, right? That's my break off point from this point. If we break off of that point, if we go above that point, then it's no longer worth it to hold the play. This is part of my risk assessment of how I analyze butterflies and whether I should hold it or sell it, right? So, if I think it's going to have a bullish move above 570, for example, then I'm going to make less than what I do now. From 819, it's going to go down to $400, $500, right? Somewhere like that. So say that this is still, it's Tuesday, July 6th. I still got time on this butterfly. I still think that, maybe it's going to stay around this range, but I want to protect my upside a little bit more. What you can do is you can add a contract to the upside. So if you add a 590C, suddenly if tomorrow, say that it's Tuesday, July 6th, tomorrow Netflix moons, right? Then you protect your range even more. And if you expand this chart, you go like, oh wow, look at this. Like if Netflix suddenly decides to moon, you make money. because basically you're saying that I'm buying another 590 call over here. It's another than buying a regular long call. It's just if you're bullish, but it's just another way to manage your butterfly if you're already in a position, right? So suddenly, like, I don't think it's gonna remain trapped in here on 550s, but I'm like, maybe it might, and I just want to protect my upside even more. Then you can just open another long call to protect that upside. So if you take this away, see what happens. You just go back to being pinned. On the other hand, if you happen to fall in this this gap area, you will still lose money, but at least you don't lose as much as you would have otherwise, right? You could have lost $1,454 there, right? So that's how you would manage that. I don't usually do this, but it is something I've seen people do before. And the same applies to the downside. You can add a put or whatever. That's just protection, right? Again, usually I just manage it, the play itself, and I don't like to add contracts to my spreads. Because usually if that happens, it just means my idea is no longer valid, or if I'm afraid of my idea no longer being valid, I should really just cut this position. Like, if it's green, like, why not take profit? And then you just move on to a new position, right? I'm like, oh, I think it's going to be more bullish now. Then I just do another butterfly and I go 550, 600, 650. I just roll it to a different position. There's no reason for me to hold on to this position if I think this idea is no longer valid. But yeah, but I have seen people, add strikes, long calls, long puts here and there to help change their strategy profit profile in order to manage that play. All right. SNR broke, sorry. That had you confused at the beginning. I look at the challenge account starting with a small amount, thinking, making these plays, and scratch my head. I was thinking they were like naked calls and didn't realize the bias covered them. No worries. Glad that we answered that question with you for spreads. So nothing that we're doing here or explaining today is naked, right? They're all covered. Okay, so they're all covered by a different strike. There's no unlimited risk on either side, so there's nothing to worry about on that. Question on closing. You can close them separately if you want. I'll talk more about that later. Hold on to your questions, guys. I see a lot of questions on how to play these. When we go through actual examples of stuff I did, maybe that will explain those questions out to you. So when to close debit butterflies. So obviously we want to achieve max profit, or as close to it as we can possibly get. But remember that dartboard analogy, it's really, really, really hard to hit that bullseye. Not likely to hit it, right? But time, and we want the asset price to move to our sold strike. We want time to go to expiration, and we want the price to be at our sold strikes to hit max profit. That is our bullseye. The chance of hitting that, not very high. Have I hit it before? Yes, I have. Got really lucky on the Amazon butterfly before. I don't remember how much I made on it, but a couple 100% or something like that. It was the perfect pin. Usually that doesn't happen. Usually I just get within a certain range of the butterfly at expiration. More on examples later. So same example again with that Netflix butterfly. So for that, in order to make max profit, we can visually see it here too. We want it to be at 550 at expiration because that's our max profit. That gives us $2,546, which is our max profit. If you get anywhere outside of that, you don't make max profit anymore. In fact, not even close to it. And then if time is further out, same thing. So that's why usually on my challenge account, you may have noticed I do a lot of weekly and 2 weeks out butterflies. It's because I have a better chance of nailing this middle strike price, because that dartboard is closer to me, right? I can nail that bullseye much more easily on these shorter term plays. And also, I start making that profit a lot sooner, because until the last couple days, Thursday, Friday, maybe even Wednesday, that's when you start really making the big bucks on butterflies. And so that's why I do a lot of weeklies and 2 weeks out on my challenge account. On my more my normal primary investment accounts, I don't do that as much. Excuse me. I do more further out plays, and I do like monthly. 4 to 6 weeks out is usually when I normally do my butterflies, and my risk management for that is a little bit different. I'll explain about that in a bit. So that's right here, when to close it. When playing 4 to 6 weeks out, close at 25 to 50% of max profit. Or if you reach 21 days out to expiration or 14 days out to expiration and you are green on the play, that is when I would just be like, close the play, just take the money, roll it out to a new position. Okay, this is just risk management here. So this is something that Tasty actually recommends, is to close 25 to 50% of max profit. So that's what they do. And 25 to 50% of max profit, okay? This is not to be confused with 25 to 50% gain. This is from max profit. So looking at that here, if we're doing 25 to 50% of max gain, you could close this on day one if Netflix goes to 554. But we're not doing based off of profit loss percent. We are doing it based off of max profit. So max profit is $2,546. 50% of that is $1,200. And 25% of that would be about $650. Can't math right now. And this is only 2 weeks out, so let's just pick a 4 to 6 weeks out play. So let's just go to August 20th, because that's a monthly call. So if I'm looking for 25 to 50% on this play by 14 to 21 days out, 25% of this is going to be about 750, 780. Can't really math that out, but somewhere around there, right? Half of it is going to be about 1,560, right? So that 1,560 takes forever to hit. You aren't going to hit it until the last day, and that's why it says 25 to 50%, because this depends on your risk tolerance. So 25% out is probably going to be like $600, $700. You're not even going to hit that by this expiration. So again, it's just dependent on your risk tolerance. The thing about Tasty's recommendation, though, of this 25 to 50% is that they are specifically referring to neutral butterflies. They're not talking about where we have our butterflies out of the money, like this is. Okay, but usually, if you're profitable by 14 days to expiration, I just take the play, right? Take it out. If you ever hit 25 to 50% of max profit, I would also take the play, take it out. For me personally, I don't really like to manage my butterflies. Okay, I'll explain a little bit about that in a bit. When playing 1 to 2 week out, which is what I'm doing on my challenge account, basically I'm performing risk assessment the whole entire time I'm in the trade. Every single day I'm looking at, what is the price now? Where are we going? If we move across time, am I still profitable? If it moves to my expected amount? If it's not, maybe I should consider taking it out. Okay? Or when asset price crosses the short strike. So if I am, say, playing July 2nd Netflix calls, right? 25% of this would be $600, or 50% would be $1,200, so you can take it anytime, probably on Wednesday. It's when you can exit, right? But if, say, on Wednesday we are at $550, or maybe that's not a good example. Let's not do $550. Let's just say we're at $533, $616, okay? And I'm looking across, and I'm like, if we hold, I can gain another $150, or if we move up, I can gain more money, right? But what if we drop? Then I lose. Usually at this point, I'm like, if I look at the chart and it doesn't look that bullish to me, I might consider taking the money off. Right? If we are above the strike, maybe I might be like, okay, it's the same risk assessment. I go across time, is this worth it? How much do I have to gain if I just move across time? I only make another $30 if we stay at this price. And say my expected move is $10 or something. We see resistance at Netflix at 580, and we see short-term support at 556, for example. And I'm like, okay, chances are, higher that I'm going to lose money than gain money. But if I happen to be at 556 and I see resistance at 560 and I see support at 540, then I'm going to be like, oh, this is great. Because even if we go all the way down to support, I still make money. And even if we go up to my resistance, I still make money. But if your support and resistance areas on the chart puts you in a negative relative to where you are now, or you don't gain that much, then maybe it's time to get out of the trade. That's what I'm doing every single day when I'm assessing my butterflies. That's how I decide if I'm gonna hold it or if I'm gonna close it. Yeah. So for these 1 to 2 week butterflies, I personally like to hold it to expiration date, unless again, if I'm doing my risk assessment and I'm going, it's not worth the risk. Because current support, short-term support, is above where it would be profitable for me, or it's only marginally profitable, and resistance is way in the red for me, or something like that. Or if it's below at 30, and say I see resistance at 540, and I'm like, ooh, I don't think we have the chance to break out 540 in 2 days, right? Chances are, I might make a little bit more money, but I see support, next major support at 520, so I might actually lose money on this trade if I keep holding it. And at that point, I'm going to be like, okay, maybe I need to bail out of the trade, close it, move on to the next trade. So that's really all I'm doing every single day when I'm assessing these short-term butterflies, okay? For long-term butterflies, I just recommend just, if you should close it out early if you can. 2 to 3 weeks out is the best, and then you just keep rolling those butterflies and you just collect those small profits, right? You're basically just trying to collect premium without having too much volatility. The advantage of doing a further out play like that is because your range of profitability is so much higher in the first days of the trade, and it starts to shrink as you get, to expiration. Of course, you can also make more money, but because you have more range on this trade, for a more conservative and larger account, which is what my primary investment accounts are, not my challenge account, this is a lot better because I can slowly just collect the profits, and I have a large range of profitability as the days pass. So then I might go okay, 2 weeks out, okay, $460, not bad. I made like 40% on the trade. Let me just close out the trade here, and I roll out again to 2 more weeks out, like two more weeks from here. So I go to like August 6th or August 20th, right? So that's what I would do for a more conservative account, because you're basically just trying to collect premium here and some slight directional bias. Okay. So that's that on that. Also on 1 to 2 weeks, I also listed here when asset price crosses short strike. So if at any time on Thursday or Friday, if we cross 550, it's time to get out. Chances that you cross that strike again or stay in that area is pretty close to none, right? Like just take the money. This is pretty close to bullseye, right? So that's what I would do on the final days. If your asset price crosses your short strike, it's time to close out. Take profit, right? Managing losses, again, when the trade setup is no longer valid, right? Like, if Netflix breaks down, say 520, and say that 520 is now resistance and it doesn't look good, it looks like it's forming I don't know, let's just say there was a head and shoulders pattern or something on the chart, and I'd be like, okay, chances are we just keep going down. My play is no longer valid. Time to bail out while I still can. So that's one way to do it. Personally, I don't really manage most of my butterflies, and the reason for that is because they're limited loss, right? Butterflies are supposed to be cheap plays. This is way cheaper than if I was just playing a long call, or if I was just playing for example, July 16th, right? July 16th, right? $22. Like, if I was just playing a long call, it would cost me $22. If I was just playing a vertical spread, it would still cost me $18 because it's $22.68 minus $4.70. That's about $18. So it's more expensive than the butterfly. If I want to skew it, I can skew it, right? It doesn't matter. It's still cheaper. It's cheaper to play a butterfly than other plays. So usually my butterflies are essentially lottos. They expire worthless. They expire worthless. And if I let it run, I have enough plays that run, and I nail this spot close enough that 1 or 2 good plays for 5 or 7 or 8 plays, right? And it just depends on your comfort level how you want to manage that. Personally, for me, that's what I do, and it works, right? Like, my challenge account is proof of that. 3 months, 11 winning weeks, 1 losing week, 45% average gain per week. Okay, like, I have tons of losers. Every week I have plays that expire worthless. But you know what? Those cheap plays were so cheap anyways. Compared to the plays that are winning, it's like a drop in the bucket. You know what I mean? Granted, this is just my trade style. This trade style may not work for you. And especially if you have a really, really small account. Because right now that works for me because my account is starting to get big. It's actually like a moderate size account now. You know, it's 70K. If your account size is like 5K or less, 2K, whatever, maybe even $1,000, then you might want to manage to play a little bit more closely, because you can't afford to take those losses, right? But for me, because most of the time I am able to be correct on my plays, as long as I size in appropriately on my plays, I can take a bunch of losers, let them run, and then sometimes those losers go back into money, right? As long as I have enough time. If they're a shorter term play, maybe it's not such a good idea. But with shorter term plays, again, all I'm doing is I'm just assessing every single day the probability of me making more money relative to support and resistance where those areas are at. So for longer term plays, that's how I manage them. If they're losing, I don't really care about it. I don't mind it too much. I just let it run. If it comes back into my play, perfect. If it doesn't, then oh well as well. You know, that's... I've had a lot of plays go red, back to green, back to red, back to green. That happens all the time. So it just depends on how much time you have on your play. And that's why further out butterflies are so cheap. $687 for this butterfly compared to $1,400, right? If I just go a couple more months out. And that's because this play can go down all the way down to 460. The markets rally again, and we're back up to 550. And then rally some more, goes to 700. And then, I don't know, now that the stock is too high, it needs to pull back and it comes back down to 550, right? And it happens to be, you know, in September. And I'm like, okay, I'm just going to take profit now. You know, something like that. Don't worry about it. If it's a long term, I usually just let them run. If it's a short term play, then you should be assessing it on an everyday basis using the method I mentioned earlier. All right. Kind of talked about this already. Depends on risk tolerance, different for everybody. Questions to ask yourself: is the potential reward worth the risk at this current price? If it stays here, am I still going to make money or am I losing money? What is the expected move of the asset? Is this expected move going to take me outside of my profitability range from where I currently am at? Or is it going to bring me more closer into my profitability range? Or am I still in that range, right? Those are all things that are important to ask yourself. What is max profit, profit at current price, potential expected move? You can find out from your broker, or you just look for the 16 delta moves, right? That's another easy way to find that out. Chart support, resistance, supply, and demand. Where are those? Is this going to be able to pin it within a range of profitability for me? If it's not, probably time to get out. Real life example. Okay. Real life example. Shop. Oops, I forgot. I capitalized SHOP. But Shopify, I had this play close out yesterday, actually. Right? 625. That was yesterday. So this was 1400, 1500, 1550 long call butterfly at 2 days to expiration. So you see on this image here that it says 2D here, and that just means it's 2 days from expiring. So that's just to show you guys this was on June 23rd, which was Wednesday. So at Wednesday, this play was deep in the money. Okay, I paid $1,415 for the play, and it was worth $6,790 on Wednesday. At this point, I was really not sure. And this price here that you see at the end, this is the price that Shop was trading at on Wednesday. $1,500. Now, if you look at my strikes, you might notice that this is a debit broken wing butterfly. 1,400, 1,500 sold, buy 1,550. I wanted to pin it to 1,500. This was perfect. Okay? It was perfect. And I was like, man, I wish these contracts were expiring today, because if they were expiring today, they would be worth 10K, right? 1,500 minus 1,400, that's $100, right? Times 100, because, you know, you multiply your contract pricing by 100 to get the number. That's 10K. So I was off by 3.2K. There was another 3.2K of value, extrinsic value, to gain on this play. Actually, it says right here. This is one of the reasons why I like Tastyworks, is because it shows you all the number. I had a 94% chance of profitability on this play. And the extrinsic value, this is what the E here means. E is for extrinsic. I had $3,157 left to burn on the play in order to collect my max profit. So you can see all the the extrinsic value is all on the sold strikes, right? Because I want this to burn. And there's a little bit of extrinsic value on my in the money call option, not much anymore because it's so deep in the money. And then you got more on your out of the money call that's forming your credit spread wing. So this is just for protection, right? I expect this to completely expire worthless. So this 610 is gone basically, right? But you know that's what you're looking for is a difference here. You have a total value of $3,157 left on the trade if shop stays flat for 2 more days. And I was like, oh man, I wish it would stay the same, but I am not sure it's gonna stay the same. You know, it's so unlikely that stocks would just completely pin to one spot. So, you know, I did a quick risk assessment analysis, and we're just gonna pull up the chart for this, okay? So let's switch back here and pull up shop. Shop. So I got shop here. Let's look at, I don't know, let's look at an hourly chart here. So Wednesday was this day right here. This is Friday and this is Thursday. So Wednesday is the 23rd, right? You can see that down there. So on Wednesday the 23rd on shop, this is an hour chart. See that it pinned itself exactly at $1,500 by the close. I wish that was my expiration, but it wasn't. So I was like, okay, there's support here for shop 1500. You know, I had this line from the previous all-time highs, right? This was the previous all-time highs at 1499.75, and then I saw shop, you know, bouncing around this area. I kept bouncing off of this 1500 zone. So I was like, you know, 1500 is a pretty solid support. I think this is good. So I was like, and then I looked at my profit and analysis chart. I cannot pull that up anymore because it's already expired. So I can't pull it up using this calculator, right? But you know, usually for butterfly spreads, if it's further in the money, so for example, if it's above your sold strike, you have a little bit more profitability than if it was below the strike before expiration. Okay, just a little bit. And then on top of that, I had a debit broken wing butterfly, which has more bias to the upside than if I had done a regular butterfly. So I was like, 1500 looks like a solid support to me. I think it might bounce a little bit, but it looks like it wants to consolidate. I thought it was going to do one of those symmetrical triangles, and let me just try to draw it for you guys here. So this is what I was looking at on Wednesday. Ignore everything on Thursday and Friday, because that's, you know, hindsight is 2020, right? We always wish we knew what would happen before. Oh, I picked the wrong thing. Bear with me, guys, here as I draw this stuff. All right. So I was thinking we were just gonna trade in this symmetrical triangle, and maybe on Friday I would be at, you know, 510, 1510, 1500, something like that. You know, I was taking that gamble. So I was like, okay, we're probably just gonna bounce a little bit, but we're probably not gonna go over 1520, 1525 or so. And I looked at my profit and loss chart, and I'm like, it still looks good because I have, going back here, I had $3,000 of extrinsic value to burn. Right? Even if it goes up $20, so you minus 20 from here, I still had $1,000 of extra cash to make, right? Just from time decay on these middle strikes. So I was like, hey, why not? So I held it, and on Thursday I held it. I forgot to take a picture on Thursday. I probably should have, but I did not take a picture on Thursday, and then it was looking great, and then suddenly midday it dumped a little bit down to 1480 or so. My on Thursday, this was worth about $7,000 still, because it was at about 1480 at close. So you know, it was still within range, right? Because if it's at $70, what you're doing is you're doing 1470 minus 1400, which was your long call. All these other options expire worthless at expiration, so you don't have to worry about it. 1470 minus 1400 is 70, so that means it should be worth $7,000. So I was just at break even right there. I was like, the play was currently worth $7,000, and if it stayed completely flat, it would be, you know, sorry, it was at 1480. So actually I had like about, you know, a couple $100 to spare. But it was so close that I was just like, I am not sure if I should hold this or not. And as I was deciding what to do, I had a business phone call, so I ended up not doing anything about the trade. I just left it on, and I didn't worry about it too much because I was so deep in the money. I was like, worst case scenario, I'll just treat it as a lotto. Chances that shop drops all the way back down to my original entry of so it had to go all the way down to 14.15, 14.14 in order for me to be break even, right? So I was like, yeah, whatever. I'll just treat it as a lotto. And I didn't worry about it because I was like, shop has been so strong, market has been so strong recently. Maybe it's going to bounce back up and go back up to 1500. It did not do that. Instead, it did do that for the beginning of the day. So let's look at that on a shorter time frame, just so you guys understand what I was thinking about on Friday, yesterday. So we opened up at like 1480 or something like that. I was feeling really, really good because I was like, oh yeah, it's just going to curve up like this. It's going to form a cup and it's going back to 1500, sometime in the middle of the day, and I can just exit and I'm going to be really, really close to max profit. Maybe sell for $8,000 or $8,500, which would be fantastic. That's what I was aiming for. Usually I look for about 80% on expiration day if I am still holding something on expiration day. That's usually what I look for. So it started off great, opened at 1480, started going up to 1490, and then within 10-15 minutes it started dumping. And it went all the way down to 1460, and it kept dumping. And then I was just feeling really, really bad because I was like, man, I should have sold these. And then I was like, I don't believe this. It's dumping too much. It's gonna bounce. So I held. So I think at some point in the trade, my butterfly spread was worth like $4,000 or something, around down here. So I was basically at a net loss of like $2,000 to $3,000. My overall account was up for that day, including other expiries for that day. And this is not my challenge account, by the way. This is just my main primary account. I had a couple other call plays expiring that day that were up massive. I had Baba, for example, that was expiring that day, and that was up a couple $1,000s on that position. So I was like, whatever, like when it's easier to manage my positions when my overall account is green because I don't get as emotional over things. And this is why it's important to play a lot of plays for small amounts. Spread out your plays. My general rule of thumb on my primary investment account is about 1 to 2% per play. Okay, that's it. No more than that. In fact, you can go even less than that, but I do about 1 to 2% per play. Okay. And then if you are, for example, my challenge account, I'm much more aggressive on that. I do about 5%, 5% max. And my initial starting is about 2 to 4%. Right now, at 70K, I have about, 20 or so different positions. Maybe that's an exaggeration. It's probably closer to like, 10 to 15, I think. Maybe closer to 15. But I have about 10 to 15 positions, and they were all open at about $1,000, $1,500 each. Some of them are worth, $3,000 or $4,000 right now, and some of them are worth like $400 or $500, right? But they're all expiring at different days. I usually try to spread them out 3 or 4 expiries per week because that allows me to manage my plays more easily. I cannot have all my plays expiring on the same day. That's too risky, and you cannot manage it, right? You can't manage it. So spread them out. Spread out, how much you're putting in each play, and then over time, if your strategy is good, if your risk management is good, then it will work out, right? So, but anyways, I'm just explaining why I was able to hold shop, and it's because my account was up overall. I had other plays to counteract this down play. So I was down $2,000 or $3,000 on shop. I won about an hour after market open. So I am on the Pacific time. So you see this is like 7:10, 7:20. Market opens at 6:30 for us. So 1 hour in, I was down $2,000 or $3,000. I was still half asleep, and I was like, man, this sucks. But I was like, I'm gonna hold on to it because my account is net up. I'm just gonna take this risk because I think that it's oversold, and no other than that, just felt like it. I saw all, RSI was super low, everything, right? Like I was like, I'm just gonna hold it, and I held it. So I started going up, and I saw my account, that particular play go green, red, green, red. It was a little bit frustrating, and I closed it at about 12:10, 12:20, I think I closed it around here, about 1470. So if I had held to the end, I would have gotten a little bit more juice out of it. But you can never tell what's gonna happen. Right. So I closed out here at about 1470 because I thought this was going to be a resistance area right here from the previous day's close. And if you look at extended hours, I think you can see it a little bit more clearly. Like there's a clear line around this area. So you see this wick over here on this candle. That's about 1480, 1475, 1474, yeah. And then about here it's like 1477. So I was like, below 1480, there's this solid wall of resistance. I don't think it's going to pop up over that. So when we got to about 1470 again, I just bailed on the play. And then basically, I stressed myself for 2 more days for nothing. Because if you remember on Wednesday, this was $6,790, and I basically sold it for, almost the same amount, right? So was it worth it? I don't know. It was worth it on Thursday. I mean, it was worth it on Wednesday to hold it one more day, because, I saw, we saw this, or I saw this. Sorry, I saw this support at 1500, so I thought it was gonna bounce. So it was worth it on that day, and in fact, we made more money. If I sold this anytime here, I would have made more money. Even at the end of the day, I think I was only up like maybe $200, $300. I could have just sold it. But, I held it for one more day on Thursday to Friday. I would say it was not worth it to hold it anymore because we were on a downtrend, 1480. We're no longer near my middle strike. Maybe we continue. We had this massive sell-off. Just where it was going to continue, and that's what we did in the morning. We happened to bounce back up too, but this is more luck than anything else, right? So, you just have to analyze the risk and reward. Is it worth it or not to hold it? I would say that on Thursday was the most ideal time to sell it. I didn't, and I ended up, stressing myself for 2 days over this play. I wasn't that stressed about it actually, but it's still annoying to have to watch over it and babysit the play. Not something I really want to do. To find the optimal time to sell it, right? So usually Fridays are my day off, so then I can do that, but not that fun to have to watch and babysit the play. But yeah, I could have took it out 2 days earlier for about the same amount of money that I received in the end without having to deal with all this mumbo jumbo. So, that's an example of what I did. Maybe not a really, really ideal example, but it is something that I did. All right. I think some people are asking about the sidebars here, the volume profile visible range. This is called VPVR. You do need a premium version of TradingView to do it, but I think there are some public scripts that people have made for essentially the same thing. All it does is it's a measurement of volume on a different axis than your regular volume. So these volume candle bars show how much people are buying here, right, on each of these candles. This is the same thing, except it just shows what stock price is most likely traded, while the regular volume is showing what time was most heavily traded, right? So this is a good way to determine support and resistance levels too. So if I was, if shop was dropping or something, I'd be like, yeah, it looks like there's really, really strong support here at $1,000, $1,080. So if shop starts retracing, I look for support over here. And I mean, even without using this, you can tell just because, look, like you have rejections over here, here, and here, bounce here, 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 and here. Sure, there's like $100, $200, $100, $100 range, $150 range or so around here, but this is the area where you expect to see shop have support. On reality, support and resistance, you shouldn't think of them as lines, right? They're just zones, right? They're really zones. The price is never going to be exact. The support and resistance lines I use just because it gives me an idea of around where should I start looking for support or resistance. Catching up with other questions here. Can you buy multiple contracts for a butterfly play? Yes, you can. You can play as many as you want. And, sometimes I play one set, sometimes I play multiple sets. It just depends on how much the play costs. If the play costs a lot, then I'm more likely to play only one or two, or if the play is really cheap, I might play more. And it doesn't matter how many contracts I'm playing, I am only looking at how much the total cost of the play is, because I'm trying to size in all my plays roughly in the same area, about 1 to 2% of my count max, right? And some plays I size in less, sometimes. But you know, try to play a lot of plays, try to keep them all roughly in the same range. I do vary them a little bit based on how confident I am, but usually I try to keep them pretty close to each other, right? Not too far apart from each other, because the objective of the play is you never can completely predict the market. Anything can happen in the market, and all we're trying to do is increase our odds of success with charting, or using options to leverage our positions to protect ourselves, things like that, to increase our probability. All right. Next slide here. So how I play butterflies, I basically talked about this throughout all the slides earlier. But usually when risk reward, I want to talk about this point. I typically look for a 1 to 2.5 to 4 risk reward ratio. That means that if I am risking $1,000 in a play, I want my max profit to be somewhere between $2,500 to $4,000, ideally. Okay, this is for a high risk reward account, such as a challenge account that you can monitor and play actively. So that's what I look for on my challenge account. And this is going to be on 1 to 2 week out butterflies. I do also play, 4 to 6 week out butterflies on my challenge account, but then the risk reward ratio is a little bit different for that. So it's still around the same though, usually about 2.5. Usually I look for something a little bit higher if it's further out, right? Because usually a further out play means that it's going to be cheaper, less likely to hit. I want to be able to max out that reward if I'm correct. So I want to be able to have a better reward for being correct, for being on a harder to hit play, so to speak. And I don't really expect to hit max profits. Of course, I aim for it. Again, if I am within a certain range near expiration and my price is within a certain range, I will continue to hold that contract because I'm trying to hit that max profit and trying to squeeze as much out of that play as I can. But if it's no chance of hitting, then I will bail out of the play. That's just the risk assessment that we were talking about earlier. Time to expiration, again, 1 to 2 week for short-term high-risk reward plays, 4 to 6 weeks out for more stable income plays. When to play out of money directional butterflies, I use that to make cheap directional bets, and then I play in the money butterflies when I'm expecting movement to trade in the current range or to chop. So usually, this past week I've been mostly doing out of the money directional butterflies, but sometimes I like to do where my first leg of the butterfly play is in the money, and then I sell the out of the money play so that I still have some directional bias, and then I buy a further out of the money, right? So the reason why I do in the money butterflies is basically when I am not as confident about market movement. So by doing it in the money butterfly, what you are doing is you are lowering your break-even price. And what this means is that if I can lower it far enough to below the current price of the asset, that means that as long as Netflix holds above that break-even price, I'm making money. So that means I am trading not just one direction, but I can trade 2 directions. I'm basically saying, if Netflix falls a little bit, I can still make money. If Netflix stays flat, I can still make money. And if Netflix goes up, I can still make money. It's just a matter of how much, right? And this is why I really like to use butterflies, is because I have the option to play that way. And back in, I don't know, April or whatever, sometime earlier this year, I was trying to do more butterflies and stuff because the market was so choppy. Because the market was so choppy, it was just going back and forth, and it was dropping. Butterflies allowed me to trade these ranges and make a lot of profit without having to be too directional. I still have some directional bias because, even in a range, in a channel, for example, Amazon's been in a channel for like an year, right? As trading somewhere between 2,800 or something like that to 3,500, and it just keeps ping-ponging back and forth. It still has a range. I mean, even within a range, it still has a direction. But because it has that range, you're able to take a play in order to basically just profit off of data premium burn on one of the options and get a little bit of directional bias on one of the long options. So this is why I like butterflies, because you can play it in a lot of different kinds of market environments. But they are best played when IV is high again. So back a couple weeks back when we had the meme stocks running, and they're still kind of running right now, some of them anyways. Like I think Wish had a pop this past week. I think BB might also have popped a little bit because of earnings report or something like that. I don't really know because I didn't play them this week, but when meme stocks rise up a lot, usually the risk reward ratio for these plays is really good because it's so volatile. The premiums are juiced up, and by playing a butterfly, I can make a super wide butterfly, and it's still really cheap to play. Like I played AMC a couple weeks ago. Yeah, I don't have that play pulled up right now, but anyways, it makes the play really cheap. You can make a really wide butterfly for really cheap when IV is really high. So that's that. Have you ever played a 0 day to expire butterfly? That's a question from Sunshine. No, I have never played a 0 days to expire butterfly. I have played a 1 day to expire butterfly, but the only reason why I took it was because it was an ER play, and I actually have a slide on that later. Thank you, Young Bull, for getting the question from YouTube. So we got a question from YouTube viewer. Do you buy contracts in a single order? And if so, how good is Robinhood at filling the orders? Great question. So, as you might know, I do use both Robinhood and Tastyworks for trading. Robinhood is my challenge account, though. To be completely honest, I mean, Robinhood is not really good, the best for fills. They are not known for that. You pay a price for not paying a price, if that makes sense. On top of having your order flow sold, which, by the way, Robinhood is not the only one who does this. A lot of brokers do this, but they're most well known for it, right? Because of all the news and stuff. But this has been around for a long time, and they sell your orders to make money. And in addition to that, your orders get very low priority. So you do not always get the best fills, and you probably will most of the time never get the best fills. It just doesn't really happen, which is kind of a little bit shady if you ask me, because they're supposed to give you the best fill, right? But anyways, you get some delay in filling your orders, and you're bottom of the barrel when to get filled, basically compared to other brokers. I have had much better success getting orders filled at Tasty and even at below what I put my limit as. Like that happens pretty often. Like I put a limit at say $1.50 and I get filled at $1.42 or something like that. That's happened before. It happens. But of course I do pay fees for that. So is it worth it? Sure. Why not? But is Robinhood that bad either? I would say no, because I mean you basically pay for what you get. It's free. It doesn't cost anything. Basically that difference in price is what you pay for in the contracts, right? Sometimes in really illiquid spreads, so like some spreads sometimes have really wide between the bid and ask, like a couple dollars. In those cases, maybe it's better to use a broker where you pay a fee the best to fill you on those. Robinhood still okay. I am able to fill out those butterflies in one single order, and that's how I always fill them. I don't usually leg into plays. You can leg into plays, but usually for butterflies, I do not do that. I just open the play as one single play at the same time, right? I do, however, leg out of plays sometimes. Most of the time, I don't, but sometimes there's a reason to. And I have an example of that in a couple slides. So I'll explain more about that in a bit. Okay, so hopefully that answers your question. Robinhood, not the best. Still usable. I like them. They have their issues, of course, but it's still usable as a broker. But don't expect to get the best fills from them. If you do have a really large account, I highly encourage you to move to a better broker because you can afford it. If for people with small accounts and whenever I run a challenge account, I usually start with Robinhood just because there's no fees. And maybe I don't get the best fill, but if you just set a limit in there and you just wait, eventually you will get filled, right? Or you don't get filled. If you don't get filled, then oh well, right? You just find another play. No big deal. There's no point in paying more or extra for a play because that changes your risk reward profile. Sometimes I might go a little bit above the mid if I really like a setup or something like that, and as long as you're not having to hit the ask, then it's not too bad. All right. So, question from I don't use lotion. It took me a while to read that. So playing butterfly during earnings is a good play? Question mark. Butterflies are one of the ways you can play earnings. Okay, so for earnings, sometimes everybody knows that after earnings you get IV crush, right? It doesn't matter what your strike is, you're gonna get IV crush. Now your play can still be worth a lot if it's in the money and you got a big move in your direction, right? But most of the time, most of the contracts are gonna lose a ton of value because they're just getting IV crush and the move wasn't big enough. So this is where a butterfly can come in handy if you think you can pin a rough area for the price. And that's because butterflies, again, benefit from high IV. And when high IV drops, your butterflies gain value, right? And ERs happen to elevate IV. This is why if you're playing an ER run-up, you can play long calls if you want on that, okay? But you can also play calendar calls. Calendar calls are a great way to play a run-up into ER because IV is increasing, and that increases the value of your calendar spread. So once you get to ER, however, we expect IV to come down after the earnings report because now we know what earnings report is, we know what the results are, the move has been made, so IV drops because there's not as much volatility because the unknown is known. So at that time, that is where a butterfly spread could be advantageous, and we're trying to, benefit off of dropping IV. A butterfly is a great way to do that. However, any type of ER play is always what I consider a lotto play. I would play small on those kinds of plays. I had a seminar, my first seminar actually was on ER calendar spreads. So normally, ER calendars or calendar spreads benefit from increasing IV. So why do I play IVs for earnings report specifically? Well, that is because sometimes if you look for a specific setup, in that seminar I explained pretty clearly, but just to recap a little bit on that, ER, we expect the front-dated option to crush the most, and back-dated options to not crush as much. So when I look for ER calendar spread, I'm betting that the stock is not going to move much from the strike price that I picked for that calendar spread, right? And all I'm looking for is a IV crush play. And in that case, my most important criteria is how much IV skew there is. If the IV of the front-dated option is ridiculously high compared to the back-dated option, like 100% more, that is when I would do an ER calendar spread. That's the only time I do that. That's one of my criteria that I established when I was doing ER spreads, calendar spreads, and I took a lot of them and I studied them and I analyzed it, and that's the conclusion I came to, is that when ER skew between the front option and the back option is more than 100%, a lot of times I could just open it, in the last hour of the day before earnings report comes out, I open that calendar spread, and then the next, or during that evening or the next morning, I just set a limit for 30% gain. Most of the time I will get filled in that opening volatility move in the first, couple minutes of market opening after ER. So that's what I found to be very useful. And I have a bunch of stats on it. I did, analysis on it. That's how I came to that conclusion. I don't talk about them as much anymore because they are lotto plays. Because in the end, you never know what's going to happen with any kind of ER play. It could go sky high, it could go all the way to the bottom of the ocean, and then maybe it stays flat. So it's hard to predict, and then you have to do a lot of plays in order to be overall profitable. And so overall, my success with that strategy was pretty good. It was like, I think by the time when I stopped doing it, it was like maybe 70% or something. And I only put like $1,000 per play, which I know for some people might be a lot, but for me that it wasn't. It's a really, really, really small amount, $1,000 per play. And overall, I would think when I decided to stop analyzing it, I think my overall profit was net profit was 60% or so. So it's not too bad. But anyways, it's just a really, really risky way of playing ERs. If you want to play ERs, it's one thing you can look at. But there are a lot of other more consistent, better strategies out there that we can manage better. Because ER we cannot manage. It's just hit or miss. But if you want to take a 1-day lotto, sure, go ahead. As long as it meets criteria, I think it's a good way to play. Hopefully that answered your question. Do you suggest playing butterfly spreads on accounts that have PDT rule? This question was by YOLO'd69. So, to answer your question, I mean, yes, because I really only do butterfly spreads for swinging, right? Usually when I'm doing a multi-leg strategy, it means I'm swinging. I'm not day trading. Do not use butterfly spreads for day trading. You can if you want, or maybe if it's like a 0 day to expire, sure you can. But usually if you're day trading, that means that you're looking for really, really big moves in a short amount of time. And that usually means that you're going to be better off just getting a long call and then selling the long call, right? Once you get the move. Just a different type of trade style, right? I don't day trade much anymore. I used to. But now I find it better for me, for my schedule, just to swing trade. And so this is using option strategies is the better way to do it instead of doing a long call or a long put. But if you are day trading, just long calls and long puts are great for day trades. They're really, really good momentum plays. So yes, butterflies are good for PDT because you're not day trading at all. So that probably answers your question in a different way, but yeah, you don't need PDT. You don't need a day trade with butterflies. You should not be day trading with butterflies. It's not the best strategy for day trades. So, do you close them all at once or individually for the legs of the butterfly? That's a question by Yaba88, and yes, I do close them individually, and I also close them all together at the same time. I think we might have mentioned this earlier. I will have a slide later giving an actual example of this. So just give me a second on this. And then we got another question from Big Swings. Can we follow your butterfly plays? I think you mentioned this earlier. Yes, you can follow my butterfly plays. I list them all on the Discord for Xtrades, so come and check us out if you haven't joined already. And also a side note, for anybody who has a lifetime platinum membership, with that you do have 2 hours of mentoring, one-on-one mentoring. So if you want to get mentoring, I am available for that. We also have other folks in the chat who are also available for that. I know 007 was here earlier. He is also available on the mentoring list, and he is the one who is regularly here Monday through Friday after hours doing your charts for you guys on this channel, Twitch channel. So if you guys want some mentoring, that's where you would find it. But yeah, come and check us out on our Discord at Xtrades. The bot just posted up that link so you can join them there. Did I play Nike ER? No, I did not. What is the site for calculating the butterfly options? It's called Option Strat. Oh, I see Young Bull already answered that. Thank you. How do you avoid wash sales using this strategy? So wash sales is a little bit of a sticky situation, and I don't really want to dive into that because that's more of a question for your tax professional, and I am not a tax professional. But to put it from my understanding, right, as simply as possible, options, usually, even though you're trading the same asset, so for example, if I'm trading options on SPY, if it is a different strike and a different expiration, usually your broker is not going to record it as the quote-unquote same asset. However, if you look at the actual definitions by IRS, right, they don't really have much guidance on options, to be honest, and that is really disappointing. But in it, they only say assets that are similar or like each other, substantially similar, and I'm like, well, this is actually an option that is quote-unquote substantially similar because I'm trading the same asset, just a different strike, a different day. But, I don't want to dive into that because that's just legal stuff, and no one really knows because they don't have any examples of it. They don't provide any clear guidance on it. I've done research on this before. Just go with whatever tax professional tells you. But yeah, usually with butterflies, I wouldn't worry about wash sales. You can treat it as one whole play, right, when you open a butterfly spread. And I think this is why IRS doesn't really have guidance on it because options get so complex when you do this. It's like, do I consider a one butterfly to be one play, or is each strike a different play? Yada yada yada, right? If I'm buying and selling multiple different strikes to create my one option strategy that has one name, right? Or if it's a ratio, whatever it is that one position? Is that one asset? Or is that multiple, like, a dozen, depending on how many strikes you picked? So there's a reason why there's not really clear guidance on that, is because it's getting really confusing for them to manage. But usually at the end of the year you'll get a not 401k. I'm mixing up terms here. You'll get a what's the form we get from for our brokers? Is it a 1099? No. Whatever. Anyways, you get your tax form from your broker. Blanking out on that right now, but you get a tax form from your broker, and it will say on it if you have any wash sales, and you just put that number in. So I wouldn't worry about it. And the way the broker decides it is if the CUS, what is it? Basically there's an ID number, CUSID, something like that, CSUID. But there's an ID number on every single options contract. If it is the same, then it will consider it a wash sale. If it's not the same, then they won't consider it a wash sale. So what I've noticed is that on my tax report forms, that if I play the same strike, even if it's a different expiration, it still has the same ID number. Why? I don't know, but it's the same strike. I guess it's, doesn't matter what time you buy it for. But if you're buying the asset at the same price, then it's considered the same item, right? According to their system, right? And in those cases, it will consider it a wash sale. So if I'm doing a calendar spread, it's a wash sale. But I wouldn't worry about it too much, like for directional butterflies and things like that, unless you're trading the same butterflies over and over again with the exact same strikes week after week. That's when it would become an issue, okay? But generally speaking, not really a big deal. Just report whatever your tax form says, and that's what you do. Of course, it's your responsibility to make sure your taxes are correct, but you know what? There's no good guidance on this anyways, so I think you're okay. And it is arguable that it's a different asset because it's not the same strike, not the same date, whatever. But then they may push back and they say it's substantially similar. I don't want to get into that. But yeah, I went into that longer than I wanted to. Just don't worry about wash sales. For the mentoring stuff, I would go contact Byron on our Discord for those questions. I do post my butterfly alerts, but not all of them. Sorry, I post my butterfly plays for my account, but not all of them. But I do mention all of the plays I take. So I may not be alerted, but I will mention it. So I will say, I'm looking at this, but I won't be like, hey, I'm taking this right now at this price, at this time, all the time. And that's just because of time, right? Like, I don't have time to be glued to my computer all day and report, what position I'm taking and whatnot. I have a regular job outside of trading. Trading is not my main job. It's just a side gig for me, right? So that is why. And also, I really rather people just learn how to trade for themselves instead of basing off just copying my trades, right? Because I'm not always right. I never will be always right. And I'm wrong a lot of times too. I've had a lot of flops in butterfly plays. I'm sure you guys have seen it, like Baidu. What else is there? X. I think that turned around eventually. Sometimes they turn around, sometimes they don't. But I'm wrong and I'm right. Whatever. I'd rather you guys learn for yourself and decide how to play it, right? That's really where you start making the real profit. So it was a 1099. Thanks. CUSIP. Thanks, Big Tex. I can't believe I forgot that. Thanks for answering that question. All right. I think we're done with questions here. If anybody's got any questions, feel free to drop it in the chat. And if the moderators can help me keep track of that, I would appreciate that a lot. All right, next slide. If we can go to the next slide. Okay, so this is kind of a summary slide. because I know we talked a lot of random stuff. I don't cover all the butterfly spreads here, obviously, but these are the ones that we mainly play, right? The ones I use the most. So we have the long call put butterfly. Doesn't matter if it's call or put. And this is the first one is at the money. So we do this when it is neutral. When we have a neutral bias, we don't want the stock to move. We sell at the money strikes, right? So that's the ratio below: buy one in the money, sell two at the money, buy one out of the money. Pros of it: high reward, limited risk, so it's cheap. But on the downside, it has a low probability of success, and you have risk on both sides of the trade. Meaning, if it goes too far up and it goes too far down, you lose money because you need it to stay within your wings, your range, right? So now let's talk about a long call put butterfly. Same thing, but it's out of the money. So depending on which way it's out of the money, it's directional towards that direction. So you can have a bearish bias or a bullish bias, but you're still mostly neutral, right, with these plays. So with this, you're going to be buying one in the money or out of the money. It's just kind of up to you how neutral you want to be, neutral bias you want to be. And then you're going to sell two out of the money, and you're going to be directional up to those out of the money strikes, right? And then you're going to buy one out of the money. So the advantages or differences between this one and the previous one is pretty much the same. Yeah, it's pretty much the same because this is still a regular long call put butterfly. Nothing broken about the wings. But you just have a little bit more direction towards one side until that out of the money strike gets hit. That short strike gets hit. Now, if you want more direction, you can use a broken wing butterfly. Either a debit version or the credit version, both of which I list here. So they're both more directional than just a long call butterfly or long put butterfly. And the way you do that is by skipping a strike, right? So for a debit butterfly, you're going to buy one call or buy one put, doesn't matter. You're going to buy one strike, and then you're going to skip one strike, so there's more of a space between it. And then you're going to sell the next strike over twice, and then buy the next strike. So that's the general idea. So by having that wider debit spread, because that first strikes are going to be your debit spread, then you're going to receive less credit relative to your debit, and therefore your broken wing butterfly is still a debit play. We talked about this earlier with the option strat. Maybe I'll go over it again, but if you guys have any questions about that. But it has good reward compared to the previous two options. Usually the reward is slightly less, and you also have a slightly higher risk. And remember, the risk is just meaning how much you're putting into the play, how much you can lose from the play. All right. So because it is more directional and you are eliminating risk on one side of the trade, right? Guys, remember, I should probably just pull it up. I don't have one. So let's just make this into a debit butterfly here. By limiting risk to one side of the trade, you're increasing the total cost of that play, right? And also, your max profit goes down, and that's just because you're putting more into the play. So that is what a debit butterfly does. Still has good reward, less than these previous mentioned butterflies, but it has more risk because it costs more. But on the other hand, you're on one side, so you don't have to worry about being too high because you still make money. Whereas with a regular butterfly, you start losing money if it goes too far. Okay. And then the credit version, same thing, but the only difference is that you require collateral and you're collecting credit. I think this is a better premium selling strategy. So credit butterfly, we go the opposite way, right? Now I'm getting a net credit, and this is what my profit looks like. Okay. So that's just a recap for you guys. Yeah, you can. I see a question here about ghetto spreading into butterfly. You can ghetto spread into a butterfly, and that's just basically like, for example, because really a butterfly spread is just made up of a debit spread and a credit spread, right? So if you're bearish on a stock right now, right, you can just open. Say I'm bearish on Netflix. I'm bearish on it below 550. I don't think it's gonna break 550. I think it's going to drop over the next couple days, and then maybe we'll bounce from there. Then maybe I can take a 550 to 600 credit spread, and I open that first. Then Netflix, over the next couple days, drops down to, I don't know, $500 exact. And for some reason, you think it's going to bounce there. And then I'm like, okay, it's going to bounce now. I still don't think it's going to break past 550 because there's resistance there. So I want to hold on to this credit spread to make the most out of it. So, but now I'm going to open my debit spread from 500 to 550 to make this a butterfly, because I see support here at 500 and I think it's going to bounce. So then you can open up that debit spread and then you can let it rise back into the middle of your range and collect profit on both ways. So that is one way you can do it. I don't do that. Doesn't mean you can't. I just don't do that, right? But yeah, I've seen people do that before. Same thing with legging out. You can also leg out. How to find butterfly plays. A lot of you guys have been asking me, and a lot of you guys have been asking about alerts. We do have it on our Discord. This past weekend, I published our weekend analysis report, where I took tickers from people and I analyzed them, both fundamentally as well as by charts. Not so much on the fundamentals, actually, mostly technicals, because I wasn't doing that much research on those companies this past week. But I published a weekend report. I try to publish it every week. And the third part of the weekend report is always going to be my personal watch list. And starting this past week, I converted it to my butterfly watch list. And I basically listed out all the plays I took, as well as the strikes, the expiration date. Okay, so over here, I didn't list it because this is just a table of contents. You have to actually open the file to see it, right? But all the plays I took this week on my challenge account. My challenge account that went up 45%, right? The challenge account that I got 22K in 1 week. All those plays I took this week were straight from this watch list, or I posted it in options alert, options swing, or options watch list. There were 0 plays I took on the account that were not mentioned. And in fact, Spot, one of my big winners on my biggest winner actually on my challenge account this week, I think I got a net profit of about 14K on that play. That exact strike, exact expiration, exact strikes were all from the report. And so, I mean, like if you took that on Monday, like I did, you would have gained the same amount I did, at least percentage-wise, right? I mean, of course, there's some variation because, the market goes up and down even within a single day. But, I mean, overall, it went up 350%. Even if you bought in at a high price on Monday, you still would have made money. Not to say just go blind in on these plays. The reason why it's a watch list is because I like the ideas. But you have to analyze it yourself, see if you agree with the idea. If you don't agree with the idea, don't take it. If you do, I mean, I'm presenting and doing the research for you guys, right? It's just what I think. A lot of people might not agree with the way I play either. So, just find a trade style that works for you. Please don't follow my plays just because it works for me. Because if you don't believe in the play yourself, it's really, really hard to hold the play out. I've taken people's plays before when I was first starting out, and maybe they turn a profit in the end, but I sold it at a loss because I got shaken out because I did not believe in the play. So, these are just trade ideas. Take it as you will. Same thing with alerts. You should be using those. Even if I'm giving you an exact entry price and when I'm entering it, just because I take it doesn't mean it's a good idea, right? It just means I think it's a good idea. But it has to be something that matches your trade style as well. All right. Enough spiel about that. And then we'll go to actually how to find butterfly plays other than me giving them to you. So if you guys have any tickers later, shout them out, put them in chat, and then we'll take a look at them and I'll set up a butterfly that I think is good for the play. All right, talking about legging out of butterflies, which we were talking about earlier, right? So I know somebody also asked because they wanted to see the Baba play this week. I don't remember who asked for that, but I happen to have that in the slides, so we left it off for now. So if you look here, this is on what is it, Tastyworks? Yep, Tastyworks. I bought 2 sets of butterflies on this. This is actually a regular butterfly. Okay, so it's not skewed. It's not a broken wing butterfly. Just a vanilla long call butterfly. So I opened on June 14th, Baba 212.5, 225, and 235. So there's a 12.5 width for each wing. That was my long call butterfly on Baba for 625. and I opened it for $3 each, I believe. So that's $6 total, or not $6, but $600, right? And then on 6/24, so 10 days later, I laid out of the play, right? So you notice here that the only thing I did was I closed out my credit spread, right? And I bought back all my shorts. So I bought all 4 225Cs, and then I also sold my my long call, that credit spread part of the butterfly, right? So basically, after doing this, all I was left with on Baba were these long calls. I was holding June 25th, 212.5 strike calls on Thursday. This was 2 days ago, because I basically closed the credit portion of my trade and the short position of my trade for 32 cents times whatever, right? It was cheap to me, because I was like, I only had to pay a little bit more to get out of this trade. And you might be going, why did you leg out of the play? Because Baba was really bullish. So let's take a look at the chart to see why I did it, okay? But that was an example of how I legged out of Baba, or how you leg out of a butterfly play. If you are really bullish on a play and you think you can break out, you can just close the credit portion of your play. And I didn't just close the credit portion of the play, I closed the protective leg of my debit spread, because I thought Baba was going to go to the moon. And you know what? It did, right? I mean, depends on how you define moon, but this is Friday, right? It went from 221 open to, at some point in the day, 230. So yeah, it went up $9, $10. Like, that's a lot. So that's why I closed my credit spread, because I was like, there's no point in playing this butterfly because it's gonna shoot. That was my thought anyways, right? So if we look here on Thursday, so I opened the play on the 14th, right? I opened it over here. I was like, the reason why I opened it was because Baba had been in a downtrend, and I was getting a little bit antsy. I think I took the play a little bit early, actually. But I took 2 weeks out on the play, or 1.5 weeks out, because I felt like it was enough for Baba to bounce back. I felt like it was about time to bounce back. Try to pull up here. There we go. So if you look here, on the 14th, where is the 14th on this chart? Is right here. So Baba was around here, okay? The reason why I took it was because I felt like, we had a shorter term trend line here that I felt was, had a chance of holding. And the reason why I took a regular butterfly instead of a broken wing butterfly, like a debit broken wing butterfly or a credit broken wing butterfly, to add more directionality, because I'm really trying to play a direction move here, right? Because I'm thinking it's going to bounce off of this. It's because I wasn't that confident. I wasn't that confident that it was going to bounce for sure from here. I just felt like there was a chance it could bounce from here. It was a good area to take a play. Like, I was like, maybe it bounces here, right? And it looks like we have support near here. Maybe we drop another $1 or $2, but that's about it. I think this is a reasonable area of support. Maybe we take a couple days longer. So I'm gonna take more than a week out. So I took like about 2 weeks out. And that's what I did. And the reason why I took 2 weeks out is because I was playing aggressive, right? Like, normally you could do longer than that if you want. It's just up to you on how you want to trade. There's no right or wrong way to do it. It's just a matter of how much risk you want and how you want to assess it. So the reason why I wasn't so sure also is because Baba had a really, really long-term trend line, this blue line right here, from 2016, right? So I traced that all the way up to this point here, and I was like, maybe it doesn't hold this short-term trend line, because look how many short-term trend line got broken. This purple one right here got broken. This blue one right here got broken from this point right here. This purple one might break. It didn't, fortunately for me, right? But I was like, maybe we break down and we go all the way down to 204, 205. So I wasn't sure if Baba was for sure going to bounce. So, but I like the risk and reward aspect of it. So I was like, I'm going to open a regular long call butterfly that's out of the money, or slightly in the money. I think it was slightly out of the money at the time. I think Baba was around 210 or so, 212 maybe. So I took 212.5, which is barely out of the money. But I took that and took the regular butterfly because I wanted to reduce my risk of downside by reducing how much I paid for the trade. Because I would still make money up to 225. Why did I pick 225? Because we had this resistance here. So we had this gap earlier in the year for Baba. So that's marked by these yellow horizontal lines here. And that's around 225, 226, right? For that top line. And then we also had a shorter line here. I marked this earlier from a previous drop in Baba. And this other line here is about 220. So I was like, it doesn't really act as support resistance, but I was like, it's probably going to fall within this range. And then we peaked out here on Baba on May 28th at around 224, 225 too. I think it's about 225. Yeah, 225.19. So I was like, you know, maybe we pop back up over here. There's resistance before that too, but I felt pretty comfortable with that being between 220 to 225. And so I went for the middle and I was like, I'm just going to go get 222.5. Is that what I did, or did I open 225? No, I actually opened 225. So I don't know. I was just trying to assess. I was trying to decide between 220, 212.5. I didn't even say it right. 222.5. I hate these middle strikes. They're so hard to say. And 225. Okay. So I was trying to decide between them, and I just ended up going with, you know, more bullish one where I went with 225, and then I just sold the next strike over the same distance out, 12.5. So I did. Oh, it actually is a bullish one. 10. But I did 10. So it was 235 instead of 237.5. I don't know if they even had 237.5, but I did 235. So I didn't want to have too much risk. I wanted to risk less money on the trade because I wasn't as sure if it was going to bounce, right? And now my lines are all messed up because TradingView does not know where the points are. But yeah, that's why I took that play. It's just because I wasn't fully confident, but I felt it was a pretty good risk-reward scenario. And I was like, if it breaks out like everything else is, it might go up really far, but chances are it could hit resistance here at 220 and just come back down. And to protect myself, I didn't make this very, very bull biased. So that's just how I decide my strikes usually. I just keep shifting these tickers or these strikes around until I find something that suits my need. Like, oh, I'm just kind of bullish, but not super bullish, or I'm not bullish much at all. You know, that's how I always vary my strikes. Okay. So I opened that play on the 14th. It went down for a couple days, not really a big deal, and it started hovering around here. And I was starting to think that it was going to be a worthless play because it went from $600 total, so $300 for each spread, to like, I think it was worth like $100 or something at some point earlier this week. So I was like, yeah, it's just going to expire worthless, whatever, I don't care, right? Because if you know me, I don't manage my losing plays. I don't really care. Like, it is worth something or it's worth nothing. For me, butterflies are low probability, high reward plays. If it doesn't hit, sure, I lose some money, but if it does hit, I'm gonna make a lot. And as long as I have enough plays and I balance out my plays, then it's fine. I do manage my winners though, right? I don't manage the losers because the play is just not worth managing. So it's worth $100 at this point, and I thought it was just gonna be worthless. And then suddenly on Wednesday or Tuesday or whatever it was, it started rising and it started going. I think at some point it was like $300, and I was like, oh, it's flat. Maybe I can get more out of it. And it just started going up. And then on Thursday, 6/24, why did I close out the credit part of my spread and I just changed it to long calls? So the reason why was because it was forming this really, really nice pattern here of a cup. We were near the 50 MA too. This is a 50 daily SMA. And you know, everybody was just thinking it was going to break out. I became really, really bull biased because everything else in the market was running up. A lot of people were jumping into, you know, China plays and stuff. And then I was looking at my play and I'm like, the credit portion of my play I'm actually up on at this point. Because on Thursday, Baba was still below 220, right? This credit spread has been sitting around on me for over a week, and it's still not in the money because it's 225 to 235. And then I was thinking to myself that, if I can buy it back for cheap, why not just buy it back? Because I'm so bullish right now. And it was only 32 cents for me to close it out. So that's what I did. I just decided to buy it back for 32 cents. I thought it was worth it for a lotto, basically. And I was like, if we pop over this 50 MA tomorrow, chances are pretty high that we're going up to 225. And that's why I closed this credit spread, because I felt this credit spread was at risk. 225. I didn't want to have to deal with waiting until the last hour to sell out my position, because that 225 is going to have a premium value on it now because it's close to being in the money. And it actually went in the money by the end of the day, so it was a good thing I bailed out of that anyways. But there's no way I could have predicted that, right? If you look here on the midday, you can see that Baba actually kind of met some resistance at this 225 area, and then it just suddenly moved at the end of the day. So I closed it before this last minute uptick on Baba. I did, however, roll my play out into a new play. So I took profits on Baba on Friday, sometime in the middle of the day. I don't remember when anymore. But it was up like $800 or something like that on this particular play, and I was pretty happy about it because I was down to being worth $100 at some point in the play, and I just wanted to show you guys. The only reason why I'm bringing up this example is just because I'm showing you guys that I legged out of the play, and that you can do that too if you have a reason to do so. The other reason why people might leg out of play is like if they it applies more to when you're doing like credit type spreads. So you're doing like a credit butterfly or something, you can roll out stuff to basically not lose on a certain position and keep rolling until for additional credit until it actually works out. That sometimes works, sometimes it doesn't work, but we're not going to talk about that today, but just letting you guys know that some people do roll out their spreads individually in order to help control or manage that position so that they can be green on the position. So I closed it out for 1040, and if you remember, I bought it for 300. So if you do the math, that's 740 times 2, so that's actually like almost $1,500 of profit. Because remember, I had two. Okay, I had two of these contracts, and I had two of these butterflies originally. So $600 originally, and then I closed it for this much. So $740 times 2 is how much I made, minus this 32-cent debit times this. So that's that. So it was a really profitable trade. I got lucky, obviously. I would say luck is just as important as everything else in trading, because we don't know what the market is going to do. We just play probabilities. And then I rolled out the Baba play. So I picked up July 16th, which is 20 days out from that play. And I opened 3 of these credit spreads because I am still bullish on Baba. And now notice that this width of this debit broken wing butterfly is a lot smaller than this one. So this one was 12.5 width and 10 width. In other words, it's only a 2.5 strike difference on this one for my bull bias. But this one is 35, and it got like what? Sorry, not 35. I got 25, and then got 10. So the ratio is a little bit different here. I'm obviously a lot more bullish now on Baba, now that it has broken above the 50 MA. So I was expecting it to reach up here to 230 at least. And it looked like it hit that, during market hours. But I opened this at 7:37 a.m., which is 1 hour after the market opened. So at the end of the day, excuse me, this play was up $666 at close. Exact. I think I posted that in winning trades because of the unusual number that it ended up in the green at. So, but yeah, that's just an example of me taking some trades. I was bullish because, we broke over 225. I felt like 225 is probably going to be a deep, reasonable support area now. Probably just with the MA here at 220. But I'm just trading this bullish bias. And the reason why I picked 250 is because that's near where the 200 daily SMA is. And then I have this horizontal support resistance line up here too. So that's just what I'm looking for. I don't know if that's what's going to happen, but that's just a trade I took. Alright, that's it on legging out of butterflies and maybe even rolling butterflies. You can do the same thing with longer term butterflies. So if you're doing like the 4 to 6 week butterfly strategy and you wait 2 weeks, and so now you're 4 weeks out, or about 28 days, you can wait one more week, 21 days, so about halfway through. So you play 6 weeks, wait 3 weeks, if you're in the money, sell it, and then you roll out, and you keep doing this, and then you just need to make sure you adjust the strikes to what is currently going on with the price action. Other considerations. I talk about this in every single thing, but I think I'm going to skip this. But if you guys want to look at that about assignment risk and stuff like that, you can read this. Usually assignment risk is most prevalent for ex-dividend dates. And that's just because if somebody's going to get a dividend for owning a stock, they may want to exercise before that record date for the dividend, so that they get the dividend. And usually it's still pretty unusual, but it can happen. It's just more likely when those dates are occurring. You can read this slide out on your own time. It will be here on the recorded video. ER butterflies. So I know somebody asked about this earlier, if butterflies are good to play for ER, and yes they are, and the reason is because ER increases IV, right? We went over that earlier. So this is the actual example, okay? I took this play in April, right? On April 30th, I posted it as a winning trade. I think April 30th was the Friday. So on that day, this was it. My smaller account had grown 500%, right? So that was from April 1st to April 30th, because April 1st is when I started this account, the challenge account. So April was being really bullish. I was playing a lot of these butterflies at that time. That account was all butterflies. I took a 3,400, 3,525, 3,650. So this is a regular butterfly, a really wide regular butterfly. And I opened that on April 28th, 2021. Okay, that was Wednesday. That was 2 days before expiration. Did I even write down what the expiry was? No, I didn't. Okay, but anyways, this was a 2-day expiration, 2 days to expire. The expiration date was 4/30/21. Okay, it cost me $5,915 to open 2 of these. That's why you see, the reason you see 8 contracts is because each butterfly is 4 contracts total, right? You have 1 buy, you have 2 sells, you have another buy. So that's 4 contracts every single time you take 1 butterfly. So I had 2 butterfly spreads, so that's 8 contracts. That's why it says 8 contracts over here in this screenshot. And it returned 190+%, as you can see here. So the Amazon ER was the following day in after hours, on Thursday after hours. I opened this on Wednesday. So this was 2 days before earnings report and 2 days before expiration. And I closed on Friday when Amazon crossed the middle strike. You can see here that Amazon, the price at this time when I took the screenshot, was $3,530, which is pretty darn close. Pretty darn close to that middle strike that I sold. This is the ideal and perfect situation. Does this always happen? No. In fact, I say it pretty much never happens, right? But I got lucky, and voila, I made 11.5K on the trade. Great for me, right? You probably don't care. But let's go into something that you might care a little bit more about. That is why I took the trade. So, first of all, really risky, right? 2 days out from expiration, and you're taking this $5,000 bet, $6,000 bet. Are you crazy or what? Yeah, I kind of am. Kind of have to be. But Amazon, let's look at it. April 28th was when I opened the play. Let's try to find April 28th. Where is April 28th? And let me get a horizontal line going here so we can identify the time on the chart. So vertical line, did I say horizontal? I meant vertical. April 28th, it's right here. All right, so this blue line is April 28th, okay? Wow. Crazy moves. Alright. So, on April 28th, Amazon was trading somewhere between $3,435 and there's actually a really large wick here, $3,480. And it closed the day at $3,457, around there. Okay. I wish. There we go. Trying to get an hourly chart. Alright, anyways. This is what we're looking at, April 28th. Earnings report was right here. It says April 30th here, and that's because it reported after hours on April 29th, which was Thursday. So we knew the results on April 30th, which was Friday. So, you know, I took the play. I don't know when I took the play anymore, but let's just say I took it around $3,460 or so. And then notice that I did a really, really wide butterfly. It was $125 in width. That's why it's so expensive. It cost me $6,000 to open 2 of these spreads, or $3,000 each. Right? That's not something most people can do on their small accounts, anyways. If you are able to afford it, then do wide, because wide is higher probability of the play. Higher probability of the play paying out, meaning that you're more likely to make money. Of course, your return gains is less, but that's the price you pay for having higher probability. So I took this because one, previous support here, right? I saw support here. I was like, okay, chances are we're probably not going to break below 3,428, but we could. I don't know. But 3,400 looks decent here because I have a fib here at 3,407, and basically the whole previous day it traded in this range. It kept bouncing off this area. We have these other peaks here, and so I was feeling pretty good that 3,400 would be a decent support. Of course, when you're looking at ER, anything can happen. It can blow through support. It can blow through resistance very, very easily. Honestly, you don't know what's going to happen. But, you know, I wanted to take a lot of play on the ER, and so that's what I did. I analyzed it, and I was like, 3,400 looks good. I think it's going to be able to stay within this range. And then I sold, what was it, 3,525, which was up here. I actually marked that in orange. I have no idea why. I think this is because it's near all-time high. Yeah, I don't know what I'm looking at anymore, but 3,525 was what I picked, and I did 3,650 just to cover my bases, right? And I did a regular butterfly because it was really, really expensive. If I did a broken on it, it would be even more expensive. And for a lot of play, I didn't really want to do that. And the most important thing for these butterflies, though, is that, or sorry, for ER butterflies, though, is that you need to know what the expected move of Amazon is. I think the expected move of Amazon was, man, I don't even remember what it was anymore, but it was something like $100, maybe even more than $100. So I was thinking that, you know, Amazon is at 3,450, 3,470. Maybe we go up $100 to 3,570. And I was thinking about it, or maybe we go down below to 3,370. But there was that possibility, right? And then my play would be out of the money. But I was really bullish on Amazon at that time, because I don't know if you guys remember, but at that time there were a lot of rumors about Amazon having a split. And I know we get that rumor every single time we have ER, right? We get that rumor every single time. It's nothing new. It's been going on for over a year already, at least. And that's because Apple and Tesla split last year, and so everybody was like, oh, what's the next big split? Must be Amazon. And so that's where the rumor started, and it's been proliferating. So at that time, there was a lot of talk about Amazon split, and then people were super bullish, and I was like, maybe it's going to happen. So I was like, what's the expected move? And I'm like, let's include that in my strikes, and I'm going to do it in the money, butterfly, with an out of money strike, and just, you know, for a bullish bias direction. And as long as it's somewhere within that range, I will make money or at least break even. So because my butterfly was so wide, 3,400 to 3,525 to 3,650, it cost me a little bit less than 3K per trade, right? So that means that as long as Amazon was between 3,430 and 3,620, I would make money on this play. So I was bullish on the play. So I think the expected move was I'm pretty sure it was over $100, but I don't remember how much anymore. But I'm gonna say like at least $120, right? So my expectations was that it was gonna be bullish. So I was like expected move one plus or minus 120, but I'm bull, so I'm gonna bet on bullish upside. So it was my expected move would be about 3,600, right? And that would net me about 2K per spread because my break-even point was 3,630, right? So I felt like it was pretty good risk and reward. And usually after ERs, this is true for any stock, the stock moves so much after ERs. Like, you see this happen all the time where it shoots up and it retraces back and it fills the gap and then keeps going. And sometimes it just keeps dropping instead. But usually during the trade after an ER, and this is what I usually bet on when I do calendar spread, ERs, right? The first seminar that we had, I don't know, 3 or 4 months ago, whenever that was. But the reason why I usually do these kinds of plays is because usually I think that it's going to return at some point during the day back to return back to normal, right? And then it'll continue its move. And so that's what I was hoping for. And I remember being very, very, very nervous for ERs on April 29th, Thursday, when they reported. And I gotta scroll all the way back to April 29th now, huh? I know there's a time finder. Let's go back. April 29th, right? That's Thursday. Okay. So on April 29th, it went from $3,470 after hours, and they reported, and it shot all the way up to $3,670. I was freaking out. I was like, oh my goodness, my play is blown. Like, this is a ridiculous move. But I was like, maybe it comes back down. I don't know. So I just, this is all about being lucky, right? It's nothing about planning or anything. At this point, it's pure luck. This is why ERs are wallows. And then it retraced back throughout the evening, and then it was like 350, 3,550, and I'm like, this is perfect. If it opens like this tomorrow, I'm gonna be rolling and rolling in the cash, right? Because my strike was 3,525, and 3,550 is darn near close to a bullseye for ER play, right? And then it opened. It only cost 3,525, and I closed my play, and the rest is history. Nothing really special about that. That's just really about being lucky, quote unquote. But the reason why I took the play, the reason why I made it so wide was because of the expected move. I was bullish, and then usually ERs do stuff like this. They go up and they go down. It's really, really volatile during the day. That's usually what happens. And so I was betting at some point during the day, I would get a decent value to get out of my position. Okay, that means you have to watch the position. You cannot just set a limit sell and just walk away. I mean, you could, but chances are, for this kind of thing, and it's expiring, you need to be watching it, right? If I don't have time to watch it, I'm not going to be doing these kinds of plays. I'm going to be playing, my usual 4 to 6 week out butterfly plays. Wait 2 to 3 weeks. If it's in profit, sell it. 25 to 50% profit. I'm good with it, and then just keep rolling, right? But if I have time to play and I'm actively trading, then this is what I would do. Now, nothing really special, again, about the way I managed this trade. I just got lucky, right? The only thing was I set it up really wide to increase my probability of success. And another thing that's important is, another reason why I took this play is because it was cheap. You might be like, TimeHawk, are you crazy? This play cost $3,000 to play. But listen to me here. If I took this 3,400, 3,525, 3,650 play any other time, it would have been a lot more expensive. The reason it was so cheap for such a wide spread is because IV was so high. And really, I'm just trying to drive home the point here is that When IV is high, this is when you want to do a butterfly. If IV is low, it may not be the best time to do a butterfly. There are better plays out there. And let me show you an example of that. Darn, I closed it. Okay. I will just have to do it on here. I had a spread pulled up for I think it was Disney. I actually mentioned this in Option Swing Chat, and I think a few folks played it. Royce Dash and Moon. I think some other folks took it as well. But we were looking at Disney plays, right? And I know Royce Dad mentioned like, hey, I think Disney would be a good play for a calendar spread. And you know what? Disney right now is at an IV rank of 9. Where you're like, what does IV rank mean? So IV rank is how the current IV compares to the past 365 days of IV. So this is a way of rating the IV to a specific ticker instead of just going like, what's the IV percent? Because this IV percent here, 19%, like, you know, some stocks have naturally high IV, right? Like right now AMC is probably like, I don't know, over 100% or something. Let's just pull it up. Yeah, like it's 200% IV. It's like, oh wow, it's really, really high. But does that matter? I mean, yes, it does, but it's more important to look at the IV relative to what the options normally trade at. Because that's what we're trying to do with these spreads, is that we're trying to assess which spread is better, which option is better for us relative to normal. And because the IV is low, the IV rank on Disney is 9 right now. That means that 91% of days had an IV higher than right now for Disney. That means chances are more likely that IV is going to increase over time rather than decrease. Okay? And why is that important? It's because you play butterfly spreads when IV is high, you play calendar spreads when IV is low. And let's look at a calendar spread. This is a butterfly spread, okay? This is what a profit chart looks like for a butterfly spread. Now we're going to go over to call calendars and look at what it looks like. It looks kind of the same, right? Like you still got that tent, still the same thing. You got break evens. Go too far, go above. Go too far below, you lose money. Same thing. So people always ask, when I play butterflies, when I play calendars, it just depends on the IV. So if IV is high, that means butterflies are cheap. And then if IV goes down while you're holding those butterflies, they will rake in money faster. Whereas for calendar spreads, if IV is, you take them when IV is low, not because you want IV to be low, but because you want IV to increase from here. And the chances of IV increasing when it is low is higher, right? That's just how things work. Things bounce, things revert back to normal, right? That's how it works. So we take a calendar spread when IV is low, and if IV increases, I showed you guys with butterflies earlier how that works, right? But with calendar spreads, when it increases, look how much more profitable you are, right? It just expands your chart, makes you more profitable, more green to see. So that's why we want to take calendar spreads when IV is very low, because we expect that it can't go any lower, right? Or maybe it can, but chances are it's more likely that it's going to go higher from here. So anyways, to illustrate that point, and this just goes back to the ER spiel I was talking about earlier, I took those because they were cheap, because IV was very high on Amazon at that time. So it was a good risk and reward play to me. All right. I forgot what I actually alerted in the chat. 185C, I think is what I alerted. 185C, and I know I haven't been looking at the chat for a while for questions, but I will do that after I talk about this. So this is the player I posted in Option Swing chat for Disney. So I'm obviously bullish on it. That's why we have 185 strikes. And I did July 16th and July 2nd for this calendar call spread. Not exactly the best play in the world, but this is just something I was looking at and for illustration purposes. So it cost us $85 for this play. And notice the break even is 178.71 to 191.68. Now I'm going to do a butterfly spread and I'm going to try to achieve the same break even. And I want you to pay attention to what the debit is and what the max profit is. And I'm sure you guys already know what I'm trying to say or what it's going to look like. But, just for visualization purposes, I want you guys to see it. And for those who are visual learners. So if I took, for example, a long call butterfly for July 2nd, And the reason why I do July 2nd is because the front option is expiring on July 2nd on this calendar call spread. So that's the only way you can really kind of comparably see it, because this cutoff of this profit and loss is on the 2nd. So what was I trying to achieve again? 178.71 to 191. So I would, if I saw like say 185C, because that's the same strike that I'm trying to pin it to here, right? So what would I have to do? Because in this calendar call, we want it to be at 185. That's our ideal. This is where we make max profit. With a butterfly spread, it's the same thing. We want to be at where we sold the strikes. 185 is our max profit. So that's why I set that there. Now let's see how far I have to drag these things in order to make it make sense. 15 out is 200, 170. Yep, that's $15 wide wings on both sides. 178.71 to 192.1. Okay, this is pretty close. Can I get closer? Oh, excuse me. All right, 178, 191. Not exactly the same, but it's pretty close. What happens if I do 175? Is that closer? 178.41 and 191.68. All right, so this is pretty close, right? Maybe I can make it a little bit tighter. Yeah, that goes over now, right? So it's somewhere in between. Can't get exactly the same, but it's gonna be somewhere in between here. For the benefit of the doubt, I'm just gonna make the break even smaller to make it even easier for the butterfly. All right. So even when I make the break evens worse than the calendar spread, we're looking at $176 to take the butterfly versus $85 on the calendar spread, right? And let's look at percent too. So you get 260% at 185 on the calendar spread, and then you get you actually get a lot more on this. You get 326%. But this is at a worse break even, right? So if I widen it back up, this is a lot more reasonable and in line with this break even. So if I try to achieve the break even of the same amount, obviously it costs me even more. Now it's $340. And the most I can get is at $85 is 193%. So I mean, I would say the risk and reward might be pretty close. Okay, if you want to put it that way, but regardless of whether it's close or not, it is no questions asked here. The butterfly spread is a lot more expensive than a calendar spread for a similar play, right? We're trying to target 185. We're bullish on both. And we're trying to achieve the same break-even protective area on the play. The calendar spread is just so much cheaper. So that's why you would do a calendar spread here when IV is low. And in this case, Disney's IV rank is 9. So that's what you look for. That's when you play a calendar spread versus when you play a butterfly spread. Play butterfly spreads when IV is high and IV rank is high. So any of those meme stocks, whenever they go on a crazy run, great time to look at butterfly spreads. Same thing with ER plays. Butterflies could be really useful during ERs. If you want to play that kind of lotto move, right? When IV is really, really high, because IV always goes really high before ERs because no one knows what's going to happen. But yeah, my spiel on IV rank, when to play ER butterflies versus, when to play butterfly spreads relative to IV versus calendar spreads, because they have similar profit profiles in reality. So I do use both calendar spreads and butterflies in my main account, but for my challenge account, I'm only doing butterflies, and just because it's a challenge. I want to see how far I can go, right? Hands-on application. So before we do this is basically the Q&A time. We're just going to show stuff. If anybody has any tickers you guys want me to look at, I can look at them. And if you guys have any questions to ask right now that you want answered, feel free to drop them in the chat, and I'm going to check the chat real quick. So give me a moment here, and I'll start answering all those questions as I go through them. And I cannot believe that this session has been going on for 3 hours and 38 minutes already. This may be my longest session yet. Oh, I have not eaten lunch. So, Raja, you were asking about, could you explain the skip one strike again? That is a broken butterfly spread. And real quickly, just to show you, a broken wing butterfly, right? You can do it either credit or debit. I'm just going to show the version. So if this is my debit, if this is my long haul butterfly that I'm playing and I want to make it a skip strike butterfly, all I'm doing is I'm just making this lower, right? This is a debit version. So now you're skipping a strike, right? 175 to 185, you're skipping over 180, right? And now you're I mean, it's called a skip strike butterfly because you're skipping more strikes here than you do over here on the right side of your trade. Or if you're doing it the reverse way, you can also do it the reverse way and do 180, right? And this becomes a, well, it's supposed to be a credit butterfly. Normally you execute it for credit, like, I guess the strikes just aren't worth enough to do that. Alright, anyways, not gonna mess with it to try to show that. But yeah, that's basically it. Like, all you're doing is that there's more space on one side than the other. That's why it's called a broken wing butterfly, because one of the wings is shorter than the other. That's all a skip strike butterfly is. Yeah. Hopefully that made sense. If you still don't get it, just shoot me a message on Discord, on our Xtrades Discord server, and I will explain it in written format and show you. Big swings, asking about how to close out 1/3, 2/3, or keep a runner going. I always close out completely. I don't do runners on butterflies. When it's time to exit, it's time to exit. And if it's not time to exit, then I keep holding it until it's worthless. You know, I don't do those partial positions on that. However, when I do sometimes size into butterflies. So if I enter a butterfly and it goes down, I still think the setup is valid. I only do this for butterflies that are further out, like 4 to 6 weeks at least, maybe even longer than that, right? Then I might average down the play and I might open a few more. It just depends if the chart setup still supports it. But usually when I'm exiting, it's just one or nothing, right? I mean, not one or nothing, it's all or nothing. Sorry, 100% or nothing. Where do you get the expected move from? So 2 ways. You can get the expected move from your broker. A lot of brokers will show it to you. Maybe I will try to pull it up on Tastyworks and show you guys. Nah. That's gonna take too long. But yeah, your Thinkorswim, Tasty Trades, or is it Tasty Trades or Tastyworks? I think the broker version is Tastyworks. Tasty Trades is their educational platform. But anyways, they show that in on their where they have their weekly expiries, where they show the date of the expiration. On the far right side of the screen, you will see an expected move, right? It'll show IV in percent for that week, and then it'll have in parentheses or something like that another number, and that number is basically what the expected move is. And the other way you can find out what the expected move is, it's not exactly the same, but it's pretty close, is you just find out what call and what put has a 16 delta, right? If you don't understand how that works, go and rewatch this video because I talked about it earlier for like 5 or 10 minutes. But yeah, that's how you find out what the expected move is. Expected move is just one standard deviation. You can get that from the money calls and puts. Okay, I'm just reading the chat here. It's a yellow side on the VPVR indicator bids and blue ask. Yes, they are buys and sells. They're not bids and ask. Where do we check IV? You can check IV again from your broker. If your broker does not tell you those things, then you can also check it on barchart.com. So I will show you that real quick here. I might lose my voice after today, which is kind of bad because I actually have some talks to give tomorrow. All right. So on barchart.com, let's zoom in so you guys can see this better. This is barchart.com, barchart.com, no S, okay? If you go to S, it's a different website. So we're gonna go to options here. If you look here, there's a tab that says IV rank and IV percentile. If you click that, you will find all the stocks, all the tickers listed according to their IV rank, IV percent, etc. So this is how you find it. You can also just type in the stock ticker name here, and then pull up their stock data and or information, and then it'll tell you what the IV rank, IV percent, all that information is on there. But usually I use this because I am looking for plays that have high IV. If you've read any of my account challenge update posts, a couple of the past ones have said continuing to chase high IV. Why? Because butterflies benefit from high IV. So I'm always looking for high IV plays because I want to benefit from that, right? So that's what I'm looking for. I'm IV chasing. But yeah, this is how you find it. So IV rank, it explains it here. It's just according to the past year, and then there's also IV percentile. Okay, so you can use either IV rank or IV percentile. They both work. They're a little bit different in how and what they measure, but they both are assessing the IV relative to past performance for that stock. And then you have implied volatility, which is IV, and this IV is just showing what the IV for that ticker is for those at the money calls and puts and stuff. So, you know, it's better, go like, oh, Tesla has an IV of 57%. Is that high or low? I don't know. It sounds high to me. I mean, Disney was like, what, 11% or something? But then you go over here and you look, okay, the IV rank is only 12%, 12, 13%. The IV percentile is only 17%. That means relative to usual, Tesla is not very hot right now, okay? So that's that. That's just relative, right? I think this is going to start picking up again. But anyways, so this is how you find it out if your broker doesn't tell you, okay? Enough about that. Going back to other questions here. So I know people, Big Tax asked about IV rank, people asked about checking IV. We went over that with bar chart. What is the limit to say if IV is high or low? So 30 percentile, or sorry, IV rank greater than 30 is considered high. IV rank below 30 is considered low. That is my, what do you call it? Yardstick, ruler. Yeah, for measuring that. Yep, 007, welcome back. I am still going and I am ready to be done. IV is found on most brokers. Oh, yep, that's just another question about the same thing. Is there a website or platform to view IV? Again, barchart.com. How quickly does Robinhood close butterfly? It's actually kind of hard to close butterflies because there are so many strikes to it, and Robinhood isn't the best at filling. So, but if you close, below the mid, usually you can get filled. Not too difficult, right? If you're trying to get the optimal price, chances are you're going to be waiting for a very long time and you might never get filled. Until the underlying asset moves, and therefore your mid price is no longer mid price. So it's not that great for that. But yeah, if I need to get out, I always just lower it. Not a big deal. You might, lose a little bit here and there. But if you have a large account, I would definitely recommend a better broker. Even though they charge fees or whatever, it's worth it, right? Usually I use Robinhood as my small challenge account, and I never go over 25K until this time. And that's just because I want to see how far I can go with butterflies only on this challenge account. So recommend using another broker. I like Tasty myself. And I know 007 probably has his referral links if he wants to post those. The two call options cover the obligation. This is a question by Yaba. The two call options cover the obligation to sell shares for the two sold calls. Question mark, right? Thus, no need to own shares in the case of assignment. Your two call options will keep you covered. Yes, that is completely correct. A butterfly is a completely covered play. We have no risk in those terms. However, we do lose out on our premium paid to open the butterflies if somebody exercises both of those strikes that we shorted. And that's just because, with the way a regular butterfly is set up, we basically come to a net cost or a break even of 0, right? If someone exercises, because you have same width across both wings, then basically your loss and your profit cancels each other out. You're at $0. But in order to open that butterfly, you pay some money. But on the other hand, you can't lose more than that. That's your max loss. Ideally, no one exercises, right? Ideally, you can just sell it, before expiration with good profits. Over 50 is considered high volatility. There's a question about I don't use lotion, and you probably already know now because I said it earlier, but it's 30. Over 50 is good too. Over 50 is good too. But you just need to have IV rank over 30, and at that point, it's already considered good enough for very good butterflies. And I actually use butterflies even when IV rank is lower than that, but not that often because usually a calendar spread would be a better option than a butterfly. But I might still do a butterfly if I'm trying to create like a broken wing or something like that, where I have more directional bias. Then I might still use a butterfly. But this is really, really situational, and it just depends. For every single trade, I'm always analyzing what strategy is best for that situation. There is no one best strategy. It just depends on you, how you want to trade, and what your risk tolerance is, what your objectives are, how much time you have to trade. If you are a day trader, you're full-time trading, you can monitor those options every single day, and you're watching those charts. Sure, go ahead with your long calls and your long puts, trading on volatility, that's totally fine. If you're a swing trader and you don't have time, you work a full-time job, or you just don't want to be staring at the chart all day, then maybe you want to consider some other types of strategies, which is what we talk about here. Oh, sorry, you never left 007? Man, how far behind in chat am I right now? Said this was only going to be an hour or two still going. Yeah, I know, right? This is what always happens. I always say I'm going to try to keep it short, but I always keep going until I'm done. And I've answered all the questions. I definitely am losing my voice now. Thanks for posting that link for referrals, Young Bull. If you guys need any broker stuff like that, join our Discord. And also check out that link Young Bull just posted. That's a link to referral links by 007 if you guys need any referrals to brokers, such as Tasty Trade, E-Trade. I don't remember what else you have on there, 007, but yeah, check those links out. For meme stocks, their IV ranks seem to be very high. If we are projecting a bullish market, which tickers are you looking at for butterfly call spreads? So, join our Discord and wait for Sunday, because I will post my watch list of butterflies and tickers with butterfly suggestions for you guys to look at, and you guys can choose to take them or not. As I mentioned earlier, all my plays are from that watch list on my small challenge account. It's not that small anymore, but my challenge account, right? And I haven't taken any plays that I haven't mentioned in chat, so just hop onto our Discord channel, and you can follow me, whatever. And I'll be posting up ideas all the time. Doesn't mean that all the ideas are going to be profitable, because that's not the case at all. I lose a lot. I mentioned this earlier as well, but I also win pretty often, and the wins obviously outweigh the losses, right? I think my win rate is, I don't know. I've never actually tracked my butterfly win rate, but I think it's probably around 70%, I'd say. Something like that. Yeah, somewhere around there. But then usually when I win, like, if you guys look at winning trades, you probably notice that every single time I post a win, it's like 150, 200%, 300%, even 400% sometimes, right? Like, that's usually how these go, because I hold them to expiration. They're basically YOLOs for me, and that basically pays off, and it covers all the losses, more than all the losses. Like, let's be real here. That's the only way it's possible for me to grow an account from 2K to 72K in less than 3 months is because it's very aggressive, very high risk. Okay, enough about that. But I will go over tickers for you guys. So, but yeah, check out our Discord if you guys want to see plays to take. Again, I recommend you guys to analyze the plays yourself to see if it's actually something you agree with, because that is the most important. Don't trade because somebody else thinks something, because we are all wrong sometimes, no matter how good our track records are. Like everybody on our Discord, like you know, all our top traders, our analysts, and even some of our regulars, most of us have pretty good win rates, right? Like, you know, 70-80%. Some folks, most folks probably have over 50%, and then some people don't have such great win rates. But win rate is just one metric. It doesn't matter how high your win rate is if you're not making money, because you could be right 100 times, but if you're making only $1 on the trade, it doesn't mean anything. So you know, take win rate with a grain of salt too. But yeah, people are right and people are wrong. It doesn't matter. We're all just guessing here. Just make sure your risk management is good and you're assessing those trades appropriately, and that's really how you make money. But yeah, let's take a look if there are any good plays right now, because that's what I really want to do. If somebody has a ticker they want me to look at, drop it in the chat. Otherwise, I'm going to use barchart.com, and I'm going to try to find some plays using barchart.com, so you guys know how to find those plays for yourself too, even if you have no idea where to start. Plug, okay? We can take a look at that. I don't use Lotion. We'll check that out. MA Bros 86, you're thinking about Regeneron 550, 570, 580? Yeah, we can look at Regeneron too. So I got Plug and Regeneron on the list, and I'm going to do what 007 always do, and I'm going to have a little text document here because I am going to forget. Right. So, Plug, and then we also have Regeneron. Yeah, okay, whatever. Anybody else? So I see Clove, Wish, Tesla. Try to limit it to one ticker per person, please. Who was Plug? I don't use Lotion. Man, I'm not going to be able to keep track of all of this. I don't know how you do this all the time, 007. Alright, so JB Bow. I don't know if the bow is supposed to be like a bun or not, but that's what I'm reading it as. Clove, Wish, Tesla. We're just gonna do Clove. I'm gonna put Clove down. If you want me to do another ticker, let me know, but I'm only gonna do one per person at most. And I'm probably only gonna do like 5 or 6, because otherwise I'm already tired. But I just want to make sure you guys have examples too. Rules MD, Allergan. Boom Bat wants Baidu. Young Bull wants Chewy. Alright, we got a couple of people saying Baidu. Bastion only is Disney. For Disney, I would not do a butterfly. Again, we're going to be doing those calendar spreads. And I already posted one in Option Swings yesterday, and that is the one I'm actually in. Like, it's already open. So I will not be reviewing that, but if you want to check that out, I would look at that. It's a 185C for Disney, 7/16 is the back date, and 7/2 is the front date. I'm obviously bullish on Disney. Yeah. I know some people are doing 190s, but I'm not that bullish, so I did 185. TTD, mRNA. TTD. I am tripping up over my words. mRNA and X. This is it. No more, guys. If you guys want me to do like more chart stuff, you can send me a DM or something. But I don't think I'm going to be doing any more today. I think this list is long enough. Sorry, Photo Warrior. I guess I'll add that HD. No more, please. We're going to go through this. Start with plug, okay? Plug. Alright, I think don't I have some plug plays open already? I do. I don't remember what they are, because I always forget stuff I'm in, because I have so many plays open. This is also why I only have like 3 to 4 tickers max expiring every single week, because this allows me to manage my plays better, and plays that are expiring further out I don't care about as much. If it's losing, like whatever. If it's winning, great. But I only manage the plays that are expiring soon, 1 to 2 weeks at most. That's why I start looking at them, because I'm trying to make sure I am managing those profits, right? Once we are in profit, I want to make sure I'm keeping those profits. And if it's still in a profitable range, I'm going to keep holding it until it becomes a point where I'm like, okay, risk assessment, support and resistance is here. That might move me out of my profitability range. Time to close, right? As I explained earlier. That's why I have a lot of plays open, and I don't always know exactly what play I'm in, because I don't really monitor or manage them until it becomes 1 to 2 weeks. That's when I actively manage positions. Okay, plug here looks pretty good. I think I have a 35, 45, 50 for July 16th. Is what I have open. And those were actually up like 70-80% after earnings report because of this spike, and now it's back down to like almost break even, which is pretty sad, but I'm still holding them. I mean, it always sucks to see that, but you know, a couple $1,000, I think it's like $1,500 play, so I was up like $1,200, and now it's back being to $1,500. Not worried about it. There's still time on the play. The only concern I might have is if it breaks down. So what I'm seeing here is there's a small little potential for a cup and handle. But I'm really hoping that it holds this MA right here. This dotted MA right here is the 100. No, wait, it's not. This is the 20 daily SMA. This dotted line right here is the 20 daily SMA. And then we have the 50 daily SMA here in the solid blue line. Right? So we're bouncing off of that. So this is where I would expect to hold support. Unless we break down below this level, this 50 daily SMA, I'm going to continue holding these plugs. The plug butterflies until expiration. If we break down below this, then at that point I'd be like, yeah, even if the butterflies aren't worth that much anymore, I might choose to close it at that time. Or if it's really worth like not much at all, like a couple $100, then I might just be like, okay, whatever, I'm just gonna hold it until expiration, see if we get a run again. Probably not, but sometimes it happens, and with this market, you never know. Stocks go up and down all the time. It's normal, right? Like you see wide moves, happens all the time. So that's why I hold on to butterflies, because it's a limited risk profile play. There's not really much of a point in cutting it. If you're unhedged, in other words, you're playing long calls, long puts, then that's when you need to have more rigid stop losses on your plays, because your play is unkept. With a butterfly, with a vertical spread, with a calendar spread, with any type of hedge play, you're already limiting your risk by selling a call. We're also limiting our reward, but we're limiting our risk. So because our risk is already limited, we don't have to worry about it as much. So anyways, plug. If I were to open a new position right now, I would probably wait. I'd be like, I either want to see it bounce off of this 20 daily SMA, or I want to see it retrace back down here to 28. And if it goes back down here to 28, I would probably take something like 30 and maybe go for here. So I'll go for 37 or 38, and then I would stretch out the butterfly to 40 or something like that. There's also gap fill up here, which is why I took the play I did. I did 35, 45, because 45 is close to where this gap fill is, and then 50. If we can go there or not, I don't know, but that's just what I did. Yeah. So that's what I would do right now. 30 to maybe 37, and then how wide you want to make that upper strike is up to you, depending on your risk tolerance. So just to quickly show, let's pull up plug. And you should base it off of time expected. So I usually like to do 1 to 2 weeks out because I feel like it's more predictable. But you can do, I also do 4 to 6 weeks out when I'm not as sure or confident about a move, which is right now. I'm not as confident it's going to start immediately going back up from here, whereas it looks like it could, make a shallow pan for a bit and then come back up, right? So maybe I might choose to do 716 at the minimum, or I might even go further out. But yeah, that's what I would do. 30. If you want to feel more confident, 35 is reasonable, or 37. And then we're going to do, unfortunately, we don't have anything further than that, 44, right? So that will be your perfect butterfly, or regular butterfly, and that would be our range. You can shorten this too, if you're more bullish, to give it more of that vertical debit spread nature, right? That's what we talked about earlier. So if you think plug is going to blow through the roof, like it's really bullish right now, then that's what you would do. But I think a regular butterfly would be reasonable right now, just because this could go down, continue going down. So maybe I want to limit my risk a little bit more by reducing the cost of my play by doing a regular butterfly instead of a debit broken wing butterfly. If this was something else, like for example, well, let's not talk about that. Those whatevs. We're gonna go on to the next ticker. Maybe we're gonna find something that lets me explain it. All right. Longest stream. Yeah, it's pretty long. In reality, this seminar could have been multiple seminars because I explained not only regular long butterflies, but I talked about broken wing butterflies, credit, debit, calendar tree butterflies, and so forth. So usually those will each be a different seminar. Just trying to cram everything into one session. Not really the smartest move, probably. Let's look at Regeneron. Oh, should I drop these things into chat? I don't know if you guys want it. Butterfly, bee fly, yeah. Do I have the trade account? No, I don't, thank goodness. Because I don't feel like logging into my account right now because I don't even know what the password is. Somehow I feel like... Yep, I cannot post my stuff into the stream chat because I am not logged in. Alright, if you guys need an idea, the video is always here. Alright, Regeneron. Oh, it's been running. So this is something that I would choose to do a broken wing butterfly on, okay? And opt to do debit. You can do credit broken wing butterfly as well. It's the same thing, but just whether you choose to use a collateral and receive a credit or to do a debit, right? I usually prefer to do debit broken wing butterflies. But yeah, this looks really, really bullish, and it's looking like it's going on a run. So this is where I would choose to do more of a debit broken wing butterfly instead of just a regular butterfly. Of course, it could just reject here at 558, right? Like we form a kind of a cup shape here, and maybe we pan down and make a handle back down to 540, and then we bounce up, and then we keep running. That is possible. But at the same time, because the market is so bullish, and there's this huge volume candle right here. See this huge volume candle on Friday? Maybe we just break up and keep going. So this is where I would do a, that debit broken wing butterfly, and I would choose to cover my upside just in case we break over. Even if I expect that 560 is going to be my resistance, or 559. I'll probably do 560. And when deciding where to pick that strike, of course we're going to pick it at a resistance that we think, but you can pick below or above. That's just how confident you feel in the play, and sometimes the cost of the play as well. So Regeneron, feeling a little bit more confident and bullish about this one. Maybe not so much confident, but it is very bullish. So I would be taking a bullish play on this for July 16th again, because it's about 2 weeks out from next week. And I think that's a reasonable time. Monthly contracts are also more liquid, so you don't have to deal with as much with bad bid and ask spreads, because some tickers you cannot trade butterflies on because the spread is just too wide. Like, I've seen $10 wide bid ask spreads on my butterflies before, and I'm like, yeah, I am not playing that. Looks good, but can't play it, So what did I say again? 560. So that doesn't give us very much room. But if I was looking for a breakout play instead, and maybe I'm thinking that this was going to break out, then I would choose 560 as my base, and then I would pick 580 as my sold calls, and then I would just find the other play, right? But let's just say that I want to be more conservative, and I'm not sure if this line is going to break out. Then, sometimes if I want to do that, then I will take the support. And I think support, support is probably all the way down here at 513, right? Or maybe this will hold, 540. And I think this is reasonable. It looks like it could be support. You see that it whipped up here twice, and then it rejected before. And you can kind of see that it's been in previous area. That's probably why I have it marked out here. So it's acted as a kind of a resistance before too. So you can see that here where every single candle is just touching this, and it just keeps going down. And then it broke up, worked up, and then it kept going down. So basically, this is a good resistance area. That wasn't even a quick line. But which line was it? Oh, it was this one. Same thing. It acted as support and resistance here. Try to break over here. So that's why we're using that. So 540, if I was doing a more conservative play on Regeneron, so I'll pick 540 as my base. So you notice that this is an in the money, right? It's an in the money butterfly. And then I would pick my price target, which is 60, right? Because I think it's going to be maybe meet resistance over here. And then I think it might have a chance of breaking out. So normally, if you're just doing a regular butterfly, you would have a really, really small width, about 540, 560, 580, which makes this a really pretty cheap play. Like, this is a 1 to, 7? Can't math. What's 280 times 6, 1,200, 480, 1,680. So it's about 1 to 6 play, actually. And probably the easiest way to see that would be to pull up the profit and loss percentile, right? Yeah. If you can get 560 to show up on this by adjusting this, then you probably see about 600%. Okay. So anyways, about 1 to 6. So it's really, really high, higher than what I would normally take. And that's because this is a really, really narrow butterfly for 3 weeks out, 2 to 3 weeks out, right? So this is not something I would normally do. And instead, I would shorten the time frame. I would even do weeklies, right? Or maybe July 9th if I'm not feeling that confident about the move. But for this kind of play, where I have set up those strikes, and I always pick the strikes based on what I expect price action to be. But because this price action is such a short time frame price action, like I expected, hit here, bounce here, go back up, something like that, right? That's why I have to go shorter in my expiration date. July 16th just doesn't cut it. Like, if it works, it works, right? But the chance of me pinning this 560 to 3 weeks out is unlikely. This play is much more likely to play out this week, in fact. So, you'd either do the 2nd or the 9th, right? And notice it costs more, right? And why does it cost more? It's because, remember, that dartboard analogy? The dartboard is now closer to you, much easier to hit that bullseye. You move the dartboard further out. I'm not going to that because, hey, your chance of hitting that bullseye is a lot less. So it's like if you're at, a carnival or a fair playing one of those games, right? But yeah, so I'd either do July 2nd or July 9th for this kind of play, and I'm actually bull skew it a little bit, so I'd probably do 540, 560, 570, just to give myself a little bit of upside in case it breaks out here. And, I'm going to be honest, I think that it's going to happen this week, so I'll probably do July 2nd. And this is, of course, a risky play. July 2nd or July 9th are both fine. Just know that if you do July 9th, you probably won't get as much juice out of it. So, but yeah. So look at that. Probably July 9th is probably my ideal. And to manage this play, you know, like you can break to 55.60 this week. Maybe you hit, you know, let's just say you hit 570 and you're still holding the play. Because if you look at this with a broken wing butterfly, the broken wing butterfly, you can keep going up and you're still profitable, right? Your range is infinite because you now is a broken wing butterfly, but you're just capped. It's not going to go any higher than 59% or $370 because that's basically the difference between these two spreads and your debit, right? So 370 is the most you will ever get, but in that case, what happens is if you break out really, really far, you can just keep holding it. Like you're already at max profit. There's no reason not to hold it. And that's if you expect a pullback, right? And then if sometime later you pull back by July 9th, then you would make profit on this play because all you're doing is you have no risk to the upside. And if you're like at $692, say, I don't know, Wednesday, you're at $370 profit. Your profit margin is actually highest at, you know, our the sole strike, 560. So because we don't have any upside risk, you can just hold it until July 9th, until it drops back to this price. If it doesn't drop to this price, then no loss, right? You just had the loss of opportunity because your money is stuck in a play that is not doing anything. But you know, sometimes it's worth the risk if you pop up a little bit over your expectations in a broken wing butterfly and you're ready at max profit, and you think that maybe it could retrace back. That's where you would hold it. Okay, so that's what I would do for Regeneron. Hopefully that helps. Man, I can't believe you guys are still here. And I can't believe I'm still here. Clove, okay. You know, here's what I'm gonna do. I'm probably just gonna do one more on stream, Clove, and I'm gonna take a look at these, the rest of these later, and then I am just gonna post them up in options watch list or something, and I'll add everyone. So if you guys want to see what my thoughts are, and I'm not gonna do that today. I'm probably gonna do that tomorrow, because I am yeah ready. So we're just gonna do one more. This chart, I don't know. Yeah, I remember this. I remember taking some butterflies on Clove. Clover Health Investments, like a couple weeks ago when it did this. It was a wild ride. I don't think I made anything on it. I think I lost money on it, actually. But it was really, really cheap to play. I think I did like 15, some absurd number, 20, some 5, whatever, and 50, I don't know. I don't remember. I don't think it had enough strikes for me to do what I wanted to do, so I had to really, really fudge around with the numbers for this play. I didn't make any money on it because Clove just kept dropping. But it was a really, really cheap play, really, really high reward to risk ratio. And that's because the IV just went sky high when it did this. So I didn't lose much, but of course I lost 100% of the play because I didn't cut it. And that's usually how I do that. But let's see what Clove is doing now. I want to see it bounce off of this MA here, which is the 20 daily SMA. If it doesn't hold that, it's probably going to go down below. Right? And the problem with Clove and trading these meme stocks is I can't predict what's going to happen to them. Like, I don't know what's going to happen. Like, if it suddenly catches traction again on Wall Street bets or they start buying up again, then it just goes up. And if they don't, then, you know, it's just going to consolidate down here, just like if you pull up GME or AMC or any other ticker from January. I mean, Clove did the same thing in January because it was among those stocks too back then. But, you know, it just kind of consolidated until the next big move. And we don't know when that's going to be. So it's really, really hard to play Clove like this. But I think the IV is probably pretty high on Clove. So it's probably cheap to play. As for predicting what's going to happen, honestly, on these meme stocks, I always play 1 week. Why? Because I don't know what's going to happen to the stock. It's easier for me to try to pin a price within a 1 week range than a couple week range. I do have longer plays on GME, however. going off on a tangent here. Bear with me. But for GME, why did I take some longer calendar plays on GME? It's because we have a very nice symmetrical triangle here. Maybe not very nice, but it's pretty good, right? Like, you got this symmetrical triangle pattern. We might be forming some kind of cup here. I opened some 716, which is only 3 weeks out now. Calendar call spreads on GME for 200, 300, 400. So I know it's really wide. But it's because, this is so... GME is one of the meme tickers, so it's high IV. But it's also because I expect it to bounce off of this level of about 200. Right? We have trend lines here, which kind of broken through, right? We have this lower trend line here, which is another $5, $10 lower. But we also have this, I have this line support resistance line drawn here, and you can see how it's reacted off of this line before in the past, and it's been kind of consolidating here right now. So I'm hoping that it goes like this, and it goes back up. But I don't know if that's going to happen or not. But I took a further out GME calendar call spread because I feel like the consolidation is going to take some time, and then it's going to rise. And then it's cheap to play further out, right? And I made it really wide. So that's why I did for GME. But going back to Clove. I typed that ring wrong. Clove. Clove is... Where are we going? The question everybody wants answered. Where are we going? Let me get rid of extended hours. So, yeah. I don't really have any directional bias on Clove. So I don't know how to play this. Right now I feel like it wants to go back down, if anything. But I'm also watching this 20 daily SMA here for a possible bounce, because that's what it did here. Right? It hit the 20 daily SMA right here on the... like, perfectly. Right? And then it bounced up. And now it looks like it's coming back down. So, here's what I would do, is I would wait to see if Clove goes back down here to 12.5, 12.6, 12.7, somewhere around there, 12.6 maybe, and see if it bounces off this 20 daily SMA. If it bounces off of it, that's where I would take a out of the money out of the money long call butterfly on Clove. And why? It's because it's a meme stock, so that's why I would have more directional bias on it. If it starts moving, it's going to really move. So that's what I would do. I would not choose to do like a regular butterfly for the same reason, because when these things shoot up, they really go up really fast. So I know Clove has been having some issues with the 15 mark, and that's where it's been heavily traded around this area, about 15 before, and if you look at this gap here, it's about 16, right? So if you look at this gap, it did in the previous meme run, major meme run a couple of weeks ago, you see that it rejected this area, right? So 15, 16, it's going to be tough to break past this area. So yeah, I wait for it to hit 12.6, 12.5, whatever. Or if it starts bouncing here, that's good too, right? And then you can take some out of the money call spreads. So let's go look at Clove. Oh, not calendar call spreads. I keep saying calendar call spreads. I mean to say long call butterflies. So I feel like July 16 is actually okay too on Clove, because it could do something like this for a while, right? Or it can do July 9th. Let's just do July 16th right now. My price target would be 15 or 16. Well, you know those, 15.5. Let's do that. Or I don't like it because I don't really like those 15 numbers. So let's just do this for now. Look at 12. So that's real good, right? It is real good, and this is even in the money. It's not even out of the money. So usually I just play with the numbers until I get something that matches my expectations of price action. That's all I'm really doing, is I'm trying to match my price expectations based on chart, based on expected move, which is based on standard deviations of historical moves, etc. And I'm trying to match it with my break-even price and what I think is going to be the price of the ticker. And of course, I want it to be at the middle strike on July 16th. But if we hit it before then, that is fine too. Sometimes you need to get out early if it goes on a major run. That is what I had to do on Tesla and Roku this week. Because I had 6:15, 6:30, 6:45 call butterfly on Tesla. I opened it on Monday this week. And, within 1 or 2 days, I don't remember how long it was anymore, but it blew way past that. It went up to like practically $700 something, right? So, when it blew past 640, I was like, Tesla has momentum. I cannot hold this butterfly anymore, even though it was a debit, it was a broken wing butterfly, so I would still be okay. But I was like, there's no point in holding it because I lose a little bit, because I make more when it's closer to my middle strike still, and it's still early on in the trade. So I just closed it out, and then I didn't look back, right? But so that's the risk. Sometimes if it blows past, you have to be real careful, and you just gotta take profits early. So if that happens with, Clove before, and it does that, within a couple of days instead of my expectations of taking longer for it to play out, then sometimes you just have to take your profits early. So as I said, I like to manage my winners. I don't manage my losers. So in that case, you're winning because your trade is up. It's time to get out because it's no longer, the risk and reward is not there. The chance that it's going to blow past your strikes is really high, so it's not worth holding it for that small premium collection probability. Okay. So I made this a broken wing, a debit broken wing, just to give us that more bullish bias. And now you can see that the break even is above 1277, which if you are bullish on Clove, this is great because that means you can't lose if it's above 1277, which is where above where our 20 daily SMA is. So if you believe in this play, this is a good play to take. I would look at, yeah, even if you do bid and ask, it's still not bad, right? $77, $90, and you have potential to make 4x, right? That's profit. So I think this is a pretty good risk reward trade. And you might have noticed that this looks really different from some of the other plays that we looked at earlier. And that's because Clove is a meme stock and its IV rank is really, really, really high right now. And that's why these butterflies are so cheap to play. This is why we chase high IV when we play butterflies. So look at this IV, 183%, versus what we were looking at earlier with Disney, right? Like, it's night and day, right? Like if I do July 16th, it's a 1-to-1 risk and reward trade. And this is because IV is so low. That's why we're choosing to do calendar spreads instead of butterflies on Disney. Trying to hit home that point again. Look for those high IV plays if you want to play butterflies, because that's where you get the cheap, high reward, low risk plays. So yeah, anyways, I like this. I think this is a good setup if you're bullish. If you are bearish, however, maybe we can go back down. I would expect to at least go back down to here, 1170, which is near where we started gapping up from previously, a couple weeks ago. And even further, we may retrace back to 200 daily SMA or the 50 daily SMA is where I'll look for next supports. So that's about 10. Just for an example, if you are doing a put butterfly, let's just show it to you. Because regardless of which direction you go, long, call or put butterfly, bullish or bearish, it's going to be cheap to play because the IV is so high. So let's just take a look at, if you want to play a put butterfly, what would you do? Just for demonstration. So, I would say maybe resistance would be at, the previous high of day, 1384. So maybe I'll do like 14. Okay, that would be my base. And I like to do in the money a lot of times, just because I like to get the break even below or above, where my current price is, depending on which direction I'm going. Because I want to be like, if we stay flat, am I still going to make money? And the answer is, if that's the case, that's great, because that means I went in two directions, flat and up, or flat and down, depending on if I'm playing puts or calls. Alright, so where did we say that my expected price target was? So let's just say that we break below this 20 daily SMA, and my price target is going to be 1184. Okay. So let's just pick 11.5 if there is one. If there's none, I guess 11 is okay too. which would be 11 would be closer to where we dipped down here previously. Okay, so this is a little bit more risky, I would say, but it's still good. So 11 is reasonable price target, and in order to make this a butterfly, it would have to be $3 wide, right? So we get 8. So you can see that it's not nearly as good as the calls version. I think this is partially because of the strikes I picked, but you can see there's a 1.5 ratio. What did I do with this? Yeah, this looks so much better than this. And yeah, if you know, I would honestly just do a regular butterfly on this. I don't feel the need to protect one side. And that's because I feel like even if Clove drops, I don't think the meme runs are really done. Like, it might drop down here temporarily for consolidation or something like that, but I think it's going to pick back up again. So that's just my bias, right? If you have a different bias, you can adjust as you see fit, right? If you need to protect more downside, then you make a broken wing debit, or yeah, broken wing debit spread, and then you can protect your downside, and now you guarantee that you will make no less than $54 if it goes down below 1254. So that is what I would do for Clove. I am leaning more bullish than bearish, so I would personally like this over the put version that I showed you guys. But I mean, if we do break down this 20 daily SMA, maybe it's worth considering a weekly put down to like here 1120 or something. So to show that if we break down on Monday, right, then maybe I'll play, you know, something like 13, 11, 9, or something like that. Yeah, not the best because the range is so small on this right now. It's really narrow butterfly. If you want to widen it, you can widen it too, right? This increases your probability, but it also increases how much you have to pay for the play. Pay for the play. Okay. All right. I am done with Clove, and I think I am done with this seminar. Thanks so much, guys, for staying all the way. For those of you still here, thanks, Young Bull, for helping out. MA Bros, you're welcome. And I am good. We are going to close the seminar here. Other announcements to make. We have a academy session with Big T on Monday at 4 p.m. PST, I believe. It is posted up in the announcements, also in education posts. But he will be going over chart reversal patterns. So like candle reversal patterns, like double tops, head and shoulders, things like that. But he will be going over that on Monday, 4 p.m. And that will be hosted on the Discord. And I think somebody is going to rebroadcast that over Twitch and or other platforms. So if you guys want to check that out, then hop on. And also Monday to Friday, every single day, 007 of Wall Street is here with us to go over ERs and charts and things like that. So if you guys want more chart requests throughout the week and need help managing your plays, things like that, come and check us out Monday through Friday on this Twitch stream after hours. And it's always immediately after hours. So that's 1 p.m. PST or 4 p.m. EST, and you can do the math for any other zones. But yeah, thanks again, guys, for listening to this seminar on butterfly spreads. If you guys got any other questions, just DM me or pop into options swings and drop some messages there. We've got a lot of people who are knowledgeable about butterfly swings now. Sorry, not butterfly swings, butterfly spreads. But yeah, really excited to see some account growth from the rest of you all. Hope you guys found this helpful and make some money out of this. And until